Good morning, everyone, and welcome to Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. Let's get right to the top 3 things that you need to know to start your morning. First thing you need to know, big tech earnings are in focus this week. Microsoft, Meta, Amazon, and Alphabet all scheduled to report. In focus will be guidance for the year ahead as investors keep an eye out for tougher economic times on the horizon. So far in 2023, tech has seen their shares rebound after a down year during 2022. The tech-heavy Nasdaq Composite is up over 15% since the start of 2023. Second thing you need to know, Bed Bath & Beyond files for Chapter 11 bankruptcy. The retailer announcing it will keep its remaining Bed Bath & Beyond and buybuy BABY stores open for the next 2 months before an anticipated closure date of June 30th. The news follows months of sharp declining sales for the big box retailer, an attempted turnaround strategy which acknowledged the risk of bankruptcy protections, and a roller coaster run for the stock after being swept up in the meme stock craze. For consumers looking for last-minute deals, Bed Bath & Beyond will stop accepting its iconic blue coupons this Wednesday. And third thing that you need to know, Coca-Cola reporting earnings this morning that beat estimates, sending shares rising in the pre-market. Like many companies, Coca-Cola has been raising prices to combat rising shipping and materials costs. But customers, they didn't seem to care. Demand for products stayed strong. It was really driven by volume growth across its zero sugar product, coffee division, and sparkling drinks, even as prices increased by 11% in the first quarter. Also noteworthy, Coke's big AI bet. Coca-Cola highlighted their use of ChatGPT and DALL-E in improving marketing and customer service.
Well, about 35% of the S&P 500 members set to report earnings this week with a particular focus on big tech. Amazon, Alphabet, Microsoft, Meta, they're all in focus as earnings season is off to a better than expected start from the companies we've heard from thus far. However, investor sentiment may not be painting a rosy picture. Here with more on the key things to watch, Baird Managing Director and Market Strategist, Michael Antonelli. Michael, good morning. It is great to see you here. So it does feel like the tenor of this season thus far has been a little bit better than estimated, which, let's face it, tends to happen usually. But how are people sort of positioning as we get into this really blockbuster week for earnings?
Right, and it not only had a blockbuster week for earnings, Julie. It's good to see you too, Brad. We have GDP this week, right? We'll get a look at first quarter GDP, spending, PCE data, durable. So it's definitely a week where you're going to want to stay tuned in. Barron's just had its big money poll. You guys maybe have seen that, and there were some great tweets kind of summarizing it. I saw one that said that they interviewed about 130 money managers, and only 6% of their clients were bullish. So positioning does seem to remain very, very bearish with this notion that a recession is coming. Expectations for year-end prices in their poll was about 41.50, which is right here. So the even bullish people think that where we are right now is it for the year. Hedge funds are really kind of net short S&P futures. JP Morgan did a survey of their clients, and over 60% said the S&P would close at 3,500 or lower. So that's, a 10, 15% downside from here. So no one's positioned for this at all. And earnings, we can dig into it a little bit. Earnings better than expected, like you said, but worse than usual right now.
So even that considered, we had already heard a little bit of the inkling of how the executives wanted to address the investor community, analysts, and as well their customers when they do report earnings. And we got that from Andy Jassy's shareholder letter as well. And it sounds like they're going to try and continue to paint this picture of a growth narrative for these companies, even though in near term there could be some headwinds that they face, especially in some of their most growth friendly businesses over the past couple of years, largely thinking about some of the cloud services. Are these still growth companies?
I think they are. There's, one of the things that the history has taught me, or being in this market for, the better part of 22 years, is that even in a slowdown, there's companies that can thrive. There's companies that can find pockets to really excel in and kind of push their agenda forward. So I do think there are still growth companies to be had around. When we say that Triple Q is up so much this year, I mean, those are all mostly growth companies. It's probably because they got punished so hard last year, and they're doing a little bit better than we thought. They'll also get the boost from tailwind from cost reductions in their labor force. So, I do still think that the narrative that we're going into recession, the narrative that things are slowing dramatically, it's seductive. It's very seductive. We hear it all the time, but still companies are still performing pretty well.
Well, and what's interesting is, as you pointed out in your note to us, the companies whose earnings per share are growing fastest right now are not in what we tend to think of as those growthy sectors like tech. It's rather in places like industrials and energy. Is that where investors should be looking right now?
Right. Yeah, we've been talking about sectors a lot with our clients, the ones that are kind of interested in picking through the market right now. And energy has been one of them for a while. We believe that that secular trend is still in place, and it's something you could look for for ideas to invest in. Industrial, same thing. If you were to look at, say, a big Midwestern industrial or an ag and focused industrial, they're still doing really well. Their charts still look really good. And now their earnings are showing up as being quite strong. So these are sectors that we've been focused on. I mean, tech and materials were the ones that were doing the worst. Again, those are growthy stocks that were really flying high for a better part of a decade. So yeah, those are two sectors we're still interested in and we're engaging with clients on. Yeah.
It seems like there's also going to be a lot of people watching to see if tech companies, when they do report earnings, similar to when Elon Musk was on SNL, people were waiting to see if he'd mentioned Dogecoin at all. When people report and the earnings come through for some of these tech companies, people are going to be waiting to see what do they have to say about artificial intelligence, right? And whether or not that's a near-term type of beneficiary that they, or at least additive to their business, versus something that you would look at this and say, yeah, it's going to be a little bit more long-term perhaps. And if so, at what stage in time would you really see that come through some of the numbers?
So this is really interesting that you guys brought this up. I spend a lot of time in client events. I spend a lot of time talking directly with our clients. And the number one question recently has been around the dollar, the whole USD thing that we just went through. The number two question has been, what about AI? Is there a way that I can get involved in this? What's an interesting way for me to play this? So like you said, that is what people will be looking for. And if you were to think about kind of pure plays on AI, there aren't a lot of great ones right now. You do have these big tech giants dabbling in them and saying, hey, we have a platform for this to spread on. And again, not only do I want to see, are they talking about AI? I want to see, how is it impacting their strategic view? Is this, when I use Microsoft Office to write a blog, is AI going to be a partner with me on that? Like I'm on Amazon, is AI going to be helping me shop? Like I can't wait to hear what they say, because I'm one of these people that's not bearish on it. I think it's going to be a tremendous productivity enhancer for everyone. I know people using it today, real estate agents using it today to write listings. Like it's going to be with us, and I really want to see how these big tech companies are using them.
Well, and it's interesting you say that, because when you talk about it as interacting with it as a consumer versus investing in it, right, as an investor,
right,
those are obviously two different questions. And I've been reading a little chatter that while the big cap tech companies are saying, look over here at AI, well, maybe their core cloud businesses are slowing to some extent. So you have to wonder if they are the best way to play it, or if there are other ways to approach it.
Yeah, I've spent a lot of time thinking about this, Julie. I actually don't have a great answer, and it's kind of unfortunate when you have to say that, not only to an advisor, to a client. There's no great pure play on it yet. It's still kind of in the fringes of profit centers. It's still kind of the fringes of how we will use it. You're right, as an investor or as a customer. So I'm still looking. I'm still trying to dig into what that is. I'm sure we'll get a million ETFs, and I'm sure we'll get there'll probably be a million different marketing pitches around it. But the big tech companies, to me, are the ones where it will take root the quickest. They have the most amount of size and the most amount of product offerings. And yeah, when we see them report, we really need to kind of look away from AI for a second and say, how is your business actually doing? Because that will be important.
All right, Baird Managing Director and Market Strategist Michael Antonelli. Michael, always a pleasure to get some of your insights, and thanks for joining us this morning.
There, guys.
Thanks. Well, switching gears here, let's talk a little Bed Bath & Beyond, declaring Chapter 11 bankruptcy yesterday following years of steep losses and several failed turnaround attempts. Joining us now to discuss more are Yahoo Finance's Brian Sozzi and Yahoo Finance's Josh Schaefer. Gentlemen, thanks so much for joining here on the desk this morning. You've been writing about this, both of you, this in one way or another over the course of this weekend. Josh, when you think about what was put within this filing, what did you discover?
Yeah, Brad. So the first things that stick out, obviously, is what's going to happen to the stores, right? And is Bed Bath & Beyond still going to be open? The answer is, for now, yes. So Bed Bath & Beyond and Bye Bye Baby, they're going to be winding down 360 Bed Bath & Beyond stores and 120 Bye Bye Baby stores over the next 2 months. Those closures start on Wednesday. So for the next 2 days, it's technically still operating as a normal business. You can go and use your coupons And then on Wednesday, the closures start, and you're going to see those kind of going out of business style sales. Brad, as you pointed to, really this shouldn't come as a surprise to most people. We've been covering this story for months, really realistically years now. If you think about sales peaking in 2017 and precipitously dropping since. And so I think that's one of the bigger things that stands out when you look at this filing. And I know, Saz, you were covering this going back to August, that going out of business kind of stuff. It looked like it was going out of business basically in August with some of the pictures you were taking then. Yeah. So not exactly shocking to see this finally coming to fruition.
You know, you've been doing this for a while when you remember covering the bankruptcies of Linens and Things, Sports Authority, and Circuit City. But this has really all the makings of what sent those chains right into the trash bin. Essentially, retailers over-leveraged, not doing right by customers in terms of customer service. You have new competitors in the marketplace, and here you have Bed Bath & Beyond that has lost considerable market share over the past few years, and more so recently, to a Target, to a Wayfair, of course, Amazon, Walmart, Target. All of these chains have just done better online, putting out better customer service at a better price point. And now the other, and I would say to those thinking, well, maybe this is the last big retail chain to go under. You know, I have a story right now on Yahoo Finance homepage talking about this. You look at some new research out of UBS, Michael Lasser, friend of our show, looking for 50,000 store closures by 2027 out of close to a million stores in this country. That is a huge potential next wave of store closures in here. In large part, consumers are spending less, they're spending more on services, and we still have too many darn retail stores in this country in the age of digital shopping.
I mean, that doesn't mean whole chains are going to go out of business necessarily,
Correct.
but it means a paring down. I mean, we've been talking about the overstoring of America for quite some time now. That's been a theme. When you look at Bed Bath & Beyond specifically and sort of what went wrong, which is sort of a fascinating question to me in this case, didn't play the internet correctly, seemingly, sort of tried to pivot too late under the leadership of Mark Tritton when he was brought in by activists. And so you have to look at some of the missteps and what other retailers maybe are going to fall into that category. But in your reporting, Josh, is that kind of what happened here?
Yeah, when you look at Bed Bath & Beyond, right, you see basically they didn't get to the internet quick enough, right? So they're already losing by the time the pandemic comes. So other companies won the pandemic and Bed Bath & Beyond did not, right? Other companies got to private labels quicker than Bed Bath & Beyond. Bed Bath & Beyond did not win that shift to private labels. Look at a retail earnings release over the next couple of weeks. You're going to hear companies like Macy's, Target, all talk about growth of private labels, right? That's a big part of the growth story for companies now. That was not successful at Bed Bath & Beyond. They were late to that as well. And so I think when you think about Amazon, obviously, Saz mentioned Wayfair. Those companies have done very well online. And then you think about a Target and what they're able to do with private labels and attract people there. That's probably where some of that business goes. But again, they're still looking for a potential buyer here. I think that's worth pointing out as Saz talks about those other store closures too. And you wonder who's going to be interested in the real estate when we talk about this as an overall conversation.
And that was something that immediately came to mind as well. Beyond real estate, even the intellectual property too. Even after the Sports Authority went down, you had Dick's Sporting Goods come in and buy up intellectual property. Do you think there's something similar that we could see happen here, Saz?
I just want to say too, I remember covering the activist situation with Bed Bath & Beyond, and really one of the key people to blame here is not Mark Tritton, it is Stephen Tamaras, who you and I have talked about him before. He was the CEO from 2003 to 2019, and when he was ousted, probably one of the most horrific CEOs in retail I've ever seen outside of Eddie Lampert at Sears. Bad job, underinvested in the chain and his people, and you saw it in the stores. But to your point, Brad, a couple of ways I think for investors to just think through this here today when they see news like this. Look at the potential sales winners when this chain essentially goes out. This is billions of dollars in sales up for business, or up for grabs here. It's a Home Depot, it's a Lowe's. All these chains can benefit from them going out of business. And then I would also watch April, May, and June as these retailers, as some of Bed Bath's competitors report, what is the impact to their sales and margins as we see these big scale liquidation events. These deep discounts historically have proven just margin busters for a lot of competitors.
Well, at the same time, who else can benefit from this? Shoppers can benefit from it. Someone on our team who had a baby not too long ago had a lot of gift cards. Hey. She had a little trouble initially getting them, cashing them in at Bye Bye Baby, but then she did. She got a $450 stroller for $200. Hey. So there are definitely some bargains out there.
Well, I need a new spatula. I'm going to get a new spatula.
Only two weeks left on those gift cards, though, too. Important to know.
Oh, only 2 weeks left?
Yeah.
Okay.
That's news you can use.
2 days on the
you can use.
2 days on the coupons. 2 weeks on the gift cards. That is very important news. I mean, just to wrap it up, guys, I think what's so interesting when you have a retailer in particular go under, a lot of people have an emotional connection, right? It's not like a big company that is a business-to-business company going under. Like, a lot of people shopped in these stores. A lot of people have very fond memories of the coupons, right?
I don't. I hated going there. My mom took me there as a kid. I couldn't think of a more boring store to go to as a kid than Bed Bath & Beyond. Take me to Stearns. Remember Stearns?
I remember.
No, I don't even know what that is.
Department store.
But what about, didn't you furnish your like college dorm room with Bed Bath & Beyond?
I did. I went to IKEA.
They would make a checklist for you with all the items, Bed Bath & Beyond. That was a core part of their business, right?
Wedding registries. I mean, I'm the only married person up here, but wedding registries.
Can I go now and get my spatula? We have the store right down the street from over here.
Okay, see you later. All right, thanks, guys. Appreciate it. Well, Coca-Cola, meantime, out with a beat on the top and bottom line, fueled by price hikes as global unit case volume saw a 3% rise in the latest quarter. The beverage company reiterating its full-year forecast, continuing to expect commodity price inflation, that being a headwind on comparable cost of goods sold. Be sure to tune in later in the 10 a.m. hour. We'll be taking a closer look at Coca-Cola's results with an analyst from Wedbush, their equity research senior VP. We'll be talking about it at the bell a bit more as well. And as layoffs continue to rise in the tech industry, stock prices for the sector's giants are following suit. And as we await earnings from the likes of Microsoft, Meta, and Amazon this week, could slashing employee headcount be the driver to a strong year for tech? We wrote about this in our morning brief today. And for more, we welcome in Neha Nike, Recruit Guyan founder and CEO. Thank you for being here. Where do you think we are in the layoff cycle? That would be sort of my first thought here as we go into this week of earnings.
Yeah, I mean, we're definitely not done yet. I definitely think there's more to come. And it's primarily because not just recession, right? But there was also overstaffing during the time of pandemic. As tech companies were innovating, as more people like myself were forced to stay home. And there was all these innovative products and technologies. And basically, that was a huge rise in employees at tech companies. And now, unfortunately, there's overstaffing. So tech companies are getting rid of all the people that they've overstaffed in the last 2 years. And obviously, with the upcoming recession, tech companies have a couple of choices. The first is to increase their prices. The second is to sell more services. Or the third is to lay off employees so that they can still maintain their profit margins.
And so when we think about how they're going to, and even past these layoffs, how they're going to really be prioritizing certain parts of their business, what have we learned from the layoffs about where they still are either prioritizing where profits are coming in from, or even on the other end, slashing some of the categories that were more kind of big bets? And I'm thinking about even the metaverse headcount that had been added on at some of these tech companies. And now those ambitions, at least in the near term, have been put on ice largely.
Definitely. I definitely think that, profits are huge, right? Especially if you are wanting to look attractive to investors, current or future investors, and also people that are, equity holders in your tech business, right? Whether you're, again, pre-IPO, post-IPO, whatever that situation looks like. But also the other thing is here, with the upcoming recession, there's definitely that mentality of taking less of a risk, right? People don't want to take as many risks. Founders and co-founders are hedging their bets, so to speak, like you said, just to make sure they're maintaining the risk that they're willing to take. And also there's this culture of, okay, well, they're doing it, should we do it too? And I see that a lot with my clients where, well, I hear people in our industry within the tech realm are doing this, so we want to lay off companies too. So there's a lot of this, culture of, let's stay on trend. Let's do what other tech companies are doing so that we are saving face and gearing up for hopefully a profitable year, in the next 6 months to 9 months.
So the question is, are you getting just an absolute deluge of new clients, people who have been laid off, who are looking for new work? And are they able to find it? Is it relatively easy still?
Yeah, that's a really good question. Yes, I'm getting a couple of different clients, actually. So I'm getting clients that are, people that are laid off, unfortunately. And yes, we are able to place them still in a pretty decent time, which is anywhere from 6 to 9 weeks. Now, the reason behind that is while the bigger tech companies are laying off, the smaller tech companies or product companies, especially the B2B SaaS world, are still hiring for top talent, right? Top tech talent. Now, they might not be hiring for hundreds and thousands of jobs, but they're definitely hiring for, 7 to 10 positions every quarter. So we're still able to find and place top talent for those companies. I'm also working with companies that are scaling steadily, right? And they might not be scaling a lot by a lot of numbers, but they're scaling enough to where they still need recruiters' help to find the top talent. Because again, the market is now saturated with a lot of talent. And so having, recruiters like myself and my agency to really kind of figure out what the right person is for their specific company goes a long way. And then I have clients who are also, hiring me to transition people off. So, transitioning employees off post layoff and how to kind of secure their future as they look at other companies to join.
Even amid layoffs and even on the other side of that, the kind of talent acquisition strategy that companies are going to be rolling out as they do perhaps restaff or retrain or skill in some other parts of the business. Where do you think artificial intelligence plays a role in that? Is it on one side making the layoffs for the companies? Is it making that a more clear decision for them or an expedited decision? Or, is this something on the other side that they're also imploring to say, okay, if we've laid off in one category driven by an AI decision, where is AI telling us to add on in other parts of the business?
Yes. And what I will say is tech companies are always innovating. They're always growing. They're always looking to do the next best thing, right? So integrating AI to kind of maneuver those decisions for them is huge. And so where I've seen AI really come in, and I'll talk about talent acquisition in a little bit, but also just the rework, right? So we have a client right now where they're using AI's help to do a complete company reorg just based on where the need is for their products and services and how they can potentially pivot. And so using AI to guide those strategies. So they might be laying off people from one department, but they're growing another, or they're doing a complete restructure of one department, right? And they're telling people, like, this is not what you want to do because your job description said differently, but we are pivoting, then you are welcome to walk away and we'll happily provide severance. From a talent acquisition standpoint, the way that companies are using AI to just reduce talent acquisition costs, right? So having AI do any type of initial pre-screening or reviewing of resumes or profiles so that they are not having to pay, a sharp fee when a company finds someone. So they're still using the element of interviewing and pre-screening internally, but then they're actually using AI to make the process a lot more streamlined and efficient.
Finally, I want to ask you a question about diversity as well. With all these layoffs happening, I mean, there's been so much concern about diversity in technology for years and years, and we've seen the needle move a little bit. What do all these layoffs do to that? Is it hitting diverse folks disproportionately? Is it setting the industry back? What's your view?
Really good question. In my opinion, I don't really think that it's setting the industry back, because I do think that when layoffs are happening, they're happening based on where the profits need to go or what the rework needs to happen, right? And so I think for the most part that I know of, tech companies are making it their goal to not let it affect the DE&I strategies that they have worked so hard to build, especially during the pandemic. That's when we saw a huge rise in the DE&I initiatives. Now, on the other hand, there still remains to be interview bias and, pre-screen bias and just bias in terms of how people will perform based on their backgrounds and where they come from. And so I think that's something that we really have to proactively work on. This cannot be reactive. This has to be something that's proactive, where talent acquisition, hiring managers, tech founders really continue building this culture of diversity, equity, and inclusion, right? Because even though employees are being laid off, the new company that does hire these employees, they have to really, really be cognizant that this could affect them if they don't go in headfirst and really focus on the structure of DE&I as they onboard the employees that were laid off.
Are you finding that there is any lost momentum in that area, or do you feel like it's still keeping up and even accelerating?
I definitely think that, and again, it really varies, right, on the company size, on the company initiative. So I do see that the bigger the companies, it does become more of a numbers game, right? Because at that time, it becomes all about bandwidth. But I feel like with the smaller companies, it's a lot more thought through and a lot more about the culture within the startup. A lot of people join startups because of culture, because of the diversity piece, because of the inclusion and equity piece. So I definitely think that for the bigger companies, especially, you have to be really, really careful when you do lay off candidates or employees, and just really talk about why that was done and relate it back directly to, the profit or, your growth or reorg, right? And make that really clear and provide them the right resources so that once that they are laid off, they have all the right resources where they can find that next role that's perfect fit for them.
Naya, thanks so much for your perspective. Really interesting stuff. Naya Naik is Recruit Gyan founder and CEO. Thank you.
Thank you for having me.
Coming up, we'll get you set for the opening bell and check in on some early movers. Stick around. Coca-Cola out with a beat on the top and bottom line, fueled by price hikes, while its sparkling soft drinks grew by 3%, led by strong performance in Asia Pacific and Latin America. Those shares are up just about 1%. And so what's different, I have to admit, I was expecting a Procter & Gamble situation, right?
Yeah.
Where, and what we've seen from Coke in the past and some of the other consumer packaged goods companies is you raise prices, and so numbers beat, but unit volume goes down. But that doesn't seem to have been the case at Coca-Cola.
No, and there was better performance on their zero sugar products, at least on the volume side, and that was kind of what the interesting part was in P&G, was where the volumes were actually down, but prices were higher. Bye-bye, phone. And so ultimately here, as we're looking through some of those units that did do well, it was that Coke Zero product, it was the kind of sparkling, there it is, sparkling soft drinks, that was up. Water and sports did well. And then at the end of the day as well, they decided to highlight at the beginning of this, which caught the attention of our newsroom, Smart Water, which ensued a debate about who has the best bottled water, but a big multi-billion-dollar brand that is available in 28 markets and grew 8% on volume during the first quarter. So all that as we're discussing volume, and there was even, of course, the average selling price that was up 11% year over year. Yeah,
I'm just looking at some of the early analyst commentary here. JP Morgan calling out the beat in unit volume, which we've just been talking about, but also gross margin, which, when you raise prices, and that presumably is helping things. So we'll get some more as we talk to an analyst in the next hour, and as we have a chance to sort of go through the call. I'll be interested to hear what they have to say about costs and where costs are moderating, where costs are continuing to go higher.
Absolutely. And that interesting call out that we had mentioned earlier on in the show as well, on the AI side here.
Oh, yeah.
This was one of the highlights. They said that they're collaborating with cutting edge technology platforms to experiment, learn, and drive results. Specifically, they've collaborated with OpenAI and Bain & Co. to harness ChatGPT, as well as DALL-E. And so this is going to be kind of integrated into their marketing elements and business operations there. And if you were scratching your head trying to figure out what AI has to do with a soft drink manufacturer,
yes,
it has a play within the marketing elements for the company.
So here's the example that they already did this.
Yeah.
Create real magic. It allows consumers to become digital marketeers by leveraging AI to generate original artwork with iconic creative assets from the Coca-Cola archive. So I guess if you're anybody, you can go and like play around with Coke stuff and use images.
If you want to have a different image of the Coca-Cola polar bear drinking it somewhere else, yeah, put him in the Amazon rainforest for me, drinking Coca-Cola.
Well, that might be where he ends up if things keep going the way they're going. And it's Arbor Day, I guess, because we got is it Arbor Day? I suppose it's Arbor Day. We got the Arbor Day Foundation. We just had Earth Day, of course, over the weekend as we have the opening bell on Wall Street here this morning. And we're looking at markets to start off this very busy week for earnings, of course, and it looks like we've got a little bit of a down open, but not much of one, as people are positioning maybe more in individual stocks than they are in the market writ large. Yes, we're going to get GDP later this week, but the focus really does, Brad, still seem to be on these specific earnings, and particularly some of the big companies that are reporting this week.
Yeah, kicking off a big earnings week, and happy Arbor Day to all who celebrate according to the gospel, according to the New York Stock Exchange. Let's check in on the major averages out of the gate here on the day. You've got the Dow Jones Industrial Average. Let's populate a pretty chart for you here, and we'll put it over the past 5 days. How about that? Just to give you some context about how we've been trending going into this week. Over the past 5 days, net lower by about 0.4% out of the gate. It's up by about 0.2% here on the day. The Nasdaq Composite, you're seeing that in the red to start off this week's trading activity. As we mentioned, a lot of big mega cap tech companies that are going to be reporting earnings over the course of this week and continuing on into next week as well. And we're going to break some of those down for you even after those earnings calls. So stick with Yahoo Finance throughout the week. And Nasdaq Composite, though, down by 0.2% to start off the week, as investors really trying to gauge exactly where some of those earnings results may come out and net out at. The S&P 500, you're seeing that flat just barely to the upside here at the open. Over the past 5 days, down by about 0.4%. Let's take a look at the S&P 500. 11 sectors out of the gate this morning. We're off into the races, and as of right now, it looks like technology is pulling up the caboose. As we mentioned, that was one of the down areas to kick off today's trading activity. It's down by about 0.4% for XLK. Also, you've got communication services that is down by about 0.1%. Those really the only two laggards, though, out of the gate this morning. You've got XLB up 0.4%. Materials leading the charge here, and then also you've got a host of other, of course, industrials and real estate. They are really kind of rounding out some of the larger gainers. Overall, in aggregate, it seems like that top line up by about, if you were to average it, about 0.25% all in. And then taking a look at as some of those, as we had mentioned, those aforementioned mega cap tech companies out of the gate this morning ahead of a big week of earnings. Apple not reporting this week, but you are going to get Microsoft, Google, Alphabet, whatever you're calling them, Amazon coming out this week as well. Amazon's up by about 0.8% to start off today. So big earnings week. Big
Important correction.
Yes.
Arbor Day is Friday.
Wow, they are way ahead of it.
Well, they're drumming up interest, yes. So that you have your tree ready to plant on Friday, I guess. Okay, Arbor Day is Friday, ladies and gentlemen. Let's get to another mover here. Philips moving to the upside after a beat in its latest quarter. The company also noting it's setting aside roughly $631 million related to lawsuits over its recall of respiratory devices. Specifically, that's a sleep apnea machine that has been causing a lot of legal woes for the company, and according to its customers, it's caused them woes as well. So that aside, because the company beat, if you leave aside the funds that it set aside for this settlement, you look at the big beat there on the bottom line in particular, and the company's CEO saying that it's going to be a strong year here and that it's going to deliver low single-digit comps this year and high single-digit adjusted operating profit margin. So all of that helping the shares.
Yeah, for the overall kind of business segment performance that we've been talking about here and there, you're taking a look at the group and business segment performance there, up 6%. Some of the other divisions, there was an increase, a comparable sales increase by 15% in the diagnosis and treatment business. And then one of the other businesses worth calling out that saw an increase as well, connected care business, that saw a sales increase of about 3% during the quarter. You think about what they do in hospital patient monitoring, and then the sleep and respiratory care, as you mentioned a moment ago. But the personal health business, that actually did move lower. That was down by about 6% during the quarter. But PHG shares. We saw this coming into the start of today's trading activity. It was up by about 11% pre-market. Right now, up by 15% as trading has commenced here in the U.S. And we're taking a look at those ADRs trading here. Also, let's take a look at shares of C3.ai. They take a hit after Wolf Research downgraded the shares of the company to underperform, noting slowing growth concerns could weigh on the stock in coming months here. And this was one that you had flagged pre-market as well after this report dropped by them. It seems that they're skeptical of the ability to hit some of their fiscal year 24 targets and not willing to underwrite material revenue from some of the planned transition that C3 has as well.
Yeah, the analysts over at Wolf saying that consensus estimates for revenue growth are 10% too high, and so that it's being overestimated. And you have to talk about the context for this, right? If you look at a year-to-date chart of this company, going into today, it's up some 80% because we have seen just an absolute frenzy for anything associated with AI. C3 AI, went public, I think, in 2021, perhaps, right? So it's a relatively recent entrant to the market, and sort of, plugged along quietly, so to some degree, until we got this uptick in interest driven by ChatGPT, driven by generative AI, and then the stock just absolutely took off. And so now you have analysts like this one taking a step back and saying, okay, let's see if the fundamentals are indeed supporting that amazing performance that there's been.
And if we perhaps won't have a clear picture of who AI is actually benefiting until even a year out from now, to see whether or not companies have actually stuck with some of the ambitious goals that they've laid out, just to say that artificial intelligence is something that can be integrated into their existing business model operations, or either on the customer side, if you're a client like Coca-Cola that we were just talking about, integrating that into their marketing practices, or if you're a company that is then putting this out there as an offering, as a solution to other businesses that could benefit from it as well. And so, as you wait for the dust to really settle on who is really a beneficiary of this, it's possible that we may not know until a year and a half out from now, because the case in point is, if you look back to the number of people that were saying, or in companies that were saying, yeah, blockchain is going to be a revolutionary technology that's going to reframe the way that we operate on a day in, day out basis. How many of them are actually beneficiaries of blockchain technology right now? On the service side, you might have a few that either were able to see money or revenue in the form of consulting, and then just had those consulting fees to net out, tell somebody, yeah, you can't really use blockchain for your business. We're sorry to tell you that, but you can still pay us.
Right.
At the end of the day, one thing is going to be true, and it's going to be that the businesses that are impacted, at least in a profitable manner, by artificial intelligence, they are going to be able to show that on a more sustainable basis, not just this quarter, but 2-3 quarters out from now, and you're going to continue to hear about that.
Yeah.
And hopefully the customer has a better experience as a result too.
Yeah. Metaverse, there's another one. Let's talk about Getty. Those shares are on the move. Activist investor Trillium Capital has offered to buy the shares it doesn't already own in Getty Images in an all-cash deal. Shares are surging in this morning's trading session. The offer price is $10 a share coming from Trillium here. Now, Getty's been in play for a little while here. Trillium's already been agitating for changes here, and the shares obviously are surging on this. Getty hasn't answered yet, not that I have seen, in terms of whether it is going to be accepting this offer. And it's interesting that the shares are not rising to the offer price, right? So is this deal actually going to get done? Unclear, but Trillium's come in here and made this offer.
Yeah, it doesn't seem like there is an update yet from what I'm seeing on the investor relations side for Getty. So we'll see if they have anything to say about this matter in the near term. Coming up on the other side, though, we chat with an analyst about Bed Bath & Beyond's bankruptcy plans and what impact it could have on the broader industry. Stay tuned. Bed Bath & Beyond filed for Chapter 11 bankruptcy protection after failing multiple turnaround efforts. The company said its Bed Bath & Beyond and Bye Bye Baby stores will remain open for now. Let's dig deeper on this and what it could mean for the broader retail space. We've got Sucharita Kodali, who is the Forrester Research Retail Analyst. Sucharita, thanks so much for joining us here on The Day. You see this come across over the weekend. Perhaps there's no surprise, but net, is there anything that stuck out to you from the filing and what this means for Bed Bath & Beyond for the next, foreseeable coming weeks and months?
I mean, well, it sounds like they're going to wind down the business pretty soon because we'd heard about different bankruptcy filings, and usually it was filing for protection from debt collection, but still being able to operate the business, which is what has happened for a number of years. It's been financially distressed for some time. It did not fare particularly well during the pandemic, which is interesting because the rest of the home goods sector actually did really, really well. So I think that what we're seeing here is just the result of a series of bad miscalculations over the years. I mean, a company like this doesn't go bankrupt and shut its doors because of one bad mistake. It's usually the compounding of many bad decisions made over time. And I think that's what we're seeing here.
And just to pick on one of the decisions, perhaps, Sucharita, their pivot to private label, which happened under Mark Tritton, right, which worked for his previous employer, Target, right, which has a lot of private label stuff that people love. Was it just too late at Bed Bath & Beyond? Was it just that it's not a good fit for private label? What went wrong with that particular strategy?
Yeah, that I would say any move to private label was not one of their mistakes. There were other mistakes. Typically, private label is much more lucrative. The margins are great. It was probably a little bit, it was, a day late and a dollar short as they did it. They should have done it years ago. The issue with a company like Bed Bath & Beyond is that they're pretty much selling commodities. They're selling, kind of Oster blenders and KitchenAid and, these products that are broadly available in so many different stores, often for discounts and at a price competitive level, everywhere from Kohl's to Amazon to Walmart to Target. And when you are selling these broadly available commodities, as Bed Bath & Beyond did, it's just really, really difficult to compete, especially in the age of the internet. That's where they found themselves. The time to really have introduced private label in a big way would have been in the late 90s, before Amazon became a force in their space. And unfortunately, that really didn't happen. Even around the time that, kind of Target became a powerhouse in home goods. You have to remember, I mean, they were the Michael Graves company, that was like, kind of that diffusion line, which was a huge part of the success of Target in a sector like home goods. And, Bed Bath & Beyond just never really kept up and even tried to replicate an approach like that.
Is there a company that you think of immediately when it comes to being a beneficiary right now of a Bed Bath & Beyond shuttering?
Possibly Kohl's, actually probably Walmart and Target. I actually think IKEA is going to do well. They are continuing to open stores. They're trying to do some smaller format stores. All of those Bed Bath & Beyond employees, I think, are great candidates to potentially be employed at some of those other stores.
I guess this is a bit of a grim question, but who's next, Sucharita? Are there other retailers that we should be watching? It doesn't feel like, we kind of saw Bed Bath & Beyond happening in slow motion for a while. It doesn't feel like anyone else is necessarily on the precipice right now, but are there any that you're watching?
There are always retailers that are on the precipice because, and typically they are the ones that would be on like a Moody's list of ones that are pretty badly indebted. The retail, they tend to kind of take on debt. They'll often retire their equity or trade their equity for debt, often with the misguided notion that their business is just, kind of a spigot of cash. I saw this when I worked at Toys R Us, and they sold themselves to private equity and took on a ton of debt in that process. And that's exactly what happened with Bed Bath & Beyond. And there are any number of retailers that are still in that position. They got a lifeline that was unexpected during the pandemic, and many of the companies that should have shaken out in the last couple of years, we're going to see shake out in the next, probably 12 to 24 months. What was interesting is that we saw the lowest level of bankruptcies in 2020, 2021, and 2022 than we'd seen in a long time. You remember, like 2017 was the retail apocalypse, mainly because like 30 big retailers went out of business at the time, and people were like, "Oh my gosh, this is the beginning of the end." And that didn't actually happen. But all we're going to see, and they're going to call it a retail apocalypse again because the numbers are going to be big. But the numbers are going to be big because we did not see what we should have seen during the pandemic.
You mentioned Toys R Us, and that kind of jogs a conversation that we had here earlier on the desk with regard to IP. And of course, Toys R Us IP had changed hands a couple times. I believe originally it was True Kids, and then WHP later on acquired that. And even with the Sports Authority, we think about how Dick's went after that IP. Is there anyone that would go after, any company that would see value in Bed Bath & Beyond's IP enough to buy it?
Possibly. I mean, there is equity in the brand recognition. It is known for what it is known for. It's known for, home goods, and it's known for decent quality home goods. So at least as an online entity, I could see it living on. And who knows, there may be some opportunity, maybe as a regional physical goods retailer, or maybe as like a pop-up store or something. I mean, there are ways to think about what's left there. Is that going to be, are they going to fetch enough money for that to make any of the debt holders hold? I don't think so. But, there's definitely a value that is there. I just don't know that it's very much value.
In the meantime, use your coupons before Wednesday, Sucharita. Don't miss the deadline. Sucharita Kodali.
I have a drawer full.
As do many of us. Sucharita Kodali is Forrester Research retail analyst. Thanks for your time this morning. Appreciate it. Coming up, bearish on treasuries. Why are hedge funds making big bets that the U.S. will squeeze past tough times without a recession, maybe? We'll discuss with the strategist on the other side. Hedge funds have been making big bets that the U.S. might squeeze past tough times without a recession as Treasury short calls continue to rise. This even as markets seem to be adopting a wait-and-see approach to the Fed's rate rises and big earnings continue to roll in. A lot to consider. Joining us now is Katie Kaminsky, Chief Research Strategist and Portfolio Manager at Alpha Simplex. Katie, thanks for being here. So I'm seeing here that leverage investors, that is hedge fund investors, boosted their net shorts on 10-year Treasury futures to a record as of April 18th. Are you in that camp? And if so, why?
Second, we're in a situation right now where there seems to be a focus on inflation tolerance and a potential pause in the Fed. What I want to point out is the fact that we're looking at a pause in the Fed while we still have an inverted yield curve. That to me suggests that people haven't really thought through the potential impact on long-term cash flows. So 10-year bonds and 30-year bonds and those sort of longer term cash flows that could actually be more susceptible to challenges if inflation stays sticky.
And so, it seems like from the rate environment, at least right now, the rate's going to continue to be on the rise. So what net impact do you believe that that's going to actually have on inflation, especially as the Fed is targeting to bring down inflation so that it is not as sticky as you were mentioning a moment ago?
Yeah, so think about it this way. If you look at long cash flows and inflation, a lot of investors are thinking, okay, we're past peak inflation, it's coming down, everything is going to kind of renormalize. But in general, it seems that people do underestimate how long it's going to take for that to actually happen. And so when we think about when you're holding long-term debt with higher inflation means that there's more pressure on long-term cash flows, which means that that particular area of your portfolio could be undervalued unless we see some sort of recession. So if you have an optimistic view, the place where you might see some challenge is more in the longer term end of the fixed income curve, whereas we've already seen a lot of moves on the short end. So now I think the focus is going to be more on what happens to long-term debt.
Interesting. So it sounds like you're in that camp of shorting bonds. What are the implications, though, for equities if there is there a long-term cash flow concern as well if inflation's going to stay high and if rates are going to move higher later in the year?
So that's what's tricky with equities. Equities have really been bouncing back and forth, trying to navigate this inflation narrative for the last year and a half. It's been very hard to tell because the market's really been focused on raising rates. And so when you think about where we are right now, the optimistic scenario is, okay, so we can sort of weather through this with slightly higher inflation. And that's where earnings and other indicators of economic healthiness actually matter because it tells us that we're actually weathering some of this inflation through the equity sector. So short term, if the Fed does pause, that causes some relief, so less tighter conditions, which is good for equities. But the more long-term concern is how do you navigate inflation? If inflation is stickier, if costs go up for companies, can they actually navigate this? Can they sustain their businesses at the same level as we're seeing this first quarter, where earnings have actually come in better than expected?
And so we've continued to hear, at least over the course of the bank earnings that have come at the former part of this earnings season, that Q3 2023 is when they're expecting a recession to hit. Are you in that same camp? And is the economy heading for a recession? And if so, how shallow, mild from your purview?
Well, I think we are somewhat in the same camp because we still see that inverted yield curve. What we're really looking for is actually the signs in the fixed income market first before the equity market, because what's going to happen is once people really realize the impact on long-term cash flows, you might see a bigger drawdown in fixed income, which could predate the potential recession that we're talking about right now. Does that mean Q3? Does it mean Q4? It's really going to depend on how long it takes for the impact of inflation to affect cash flows and for the inflation to actually permeate through and see if we actually see some better conditions or not. And that could take time.
Katie Kaminsky, Chief Research Strategist and Portfolio Manager at Alpha Simplex. Thanks so much for joining us this morning.
Thanks.
Coming up, Wall Street's fear gauge on a 24-hour version. We introduce you to the one-day VIX. We've got that for you after the break.
Earnings, and more earnings. It's a big week ahead for investors. All eyes focused on the tech titans lining up with their latest earnings report. Here's what you need to know. First up, it's a doubleheader Tuesday with Alphabet and Microsoft set to drop Q1 financial results after the close. Alphabet investors will be watching for details on the company's AI investments, while Microsoft shareholders want to know if Microsoft Teams has acted as a tailwind for the company's growth. Next up, Meta. The company formerly known as Facebook will report first quarter earnings on Wednesday. While Meta has been making headlines with the latest round of layoffs, investors are likely to keep an eye on the company's monthly active users and its new strategy, the growth of the metaverse. And rounding out next week, Amazon will report on Thursday after the close. The company recently joined in on the AI race, but will their bet on artificial intelligence pay off? Investors will be listening for AI mentions on the call. We will have all that covered on Yahoo Finance, and tune into After the Call Tuesday, Wednesday, and Thursday with a breakdown of the big tech earnings calls.
The VIX, which is the volatility index, popularly known as Wall Street's fear gauge, is going through a pretty big shakeup. There is a brand new version that will track expectations of short-term market swings, and it begins today. But what does it exactly do? And what does it measure? Yahoo Finance's Inez Ferrer is here to explain. Inez?
Yeah, guys. So let's back up for a second and just let's start off with what we mean when we talk about the VIX. As you mentioned, Brad, the fear gauge, the volatility index. It's a measure of expected swings in the S&P 500 in the next 30 days. Now, the VIX is calculated using derivatives or option contracts that expire 23 to 27 days into the future. It's calculated in real time. And historically, when you see spikes in the VIX, it has coincided with financial distress. But traders have been noticing that this year and last year, there seems to have been more muted levels. So it's worth noting also that the contracts captured in the VIX expire, as I mentioned, every 23 to 27 days. So the suspicion is that the VIX isn't capturing near-term sentiment. It's not taking into account a hedge which has become increasingly popular, and that's options with 0 days to expiration. Enter into the picture now a new one-day version of the VIX, which takes into account options with 0-day expiration with the ticker symbol VIX1D. And the move towards 0-day expiration options has really accelerated since last May when short-term derivatives were expanded. And 6 months later, the use of these has almost doubled. So just to give you an idea of the mismatch between the VIX movement and the market moves, the VIX highest close was in March 2022, but a sell-off in the market really continued through the rest of the year. So right now, the VIX is sitting near the lowest levels in more than a year, despite what we have heard of softening economic data, concerns of a recession, et cetera. So this really one-day VIX is supposed to be a little bit more matching this near-term sentiment, guys.
Yeah, really interesting stuff. We're going to be watching it. Thanks, Inez, for the primer on it. Well, the luxury goods space seems to be holding up just fine. LVMH became the first European company to surpass $500 billion in market value today. It's the parent company, of course, of Louis Vuitton, Moet Chandon, Hennessy, many other brands. Now Tiffany also. It reported a 17% rise in first quarter sales earlier this month. That was more than double analyst expectations. LVMH shares hitting a record high following the results and another high in today's session.
And coming up, we've got more here on Yahoo Finance in the next hour, diving into earnings reports. We've got Coca-Cola, plus a vibe check from the earnings call. Ooh, yay.
And will the mention of artificial intelligence be the major talking points to watch from tech earnings this week? We'll talk about the impacts of AI on earnings.
Welcome back to Yahoo Finance Live, everyone. We are about 30 minutes into today's trading session. Let's get a check of the markets over with Julie Hyman over at the Wi-Fi Interactive.
Let's do it. I want to actually start with bonds here. We were just having a conversation a few moments ago with Katie Kaminsky and talking about how a lot of hedge funds are short bonds right now, short longer-term bonds. We are seeing that happen not in the market necessarily today because we've got yields moving down, which is what happens when people buy bonds. So we've got 3.53% there on the 10-year yield, moving down by 4 basis points at the moment. And going to switch on over and take a look at the sector action right now. Get a check on this after Brad checked it earlier. Real estate bringing up the caboose, as Brad likes to say, followed by information technology. And then we've got energy and healthcare actually doing the best in today's session. So that's what's happening on the sector level. On the individual level, not a whole lot of direction either. And this is interesting today because we see on the index level, not a lot of movement, but we see it on the individual stock level as well. Really what's happening here is more a function of individual movers, I would say, in today's session, which you sometimes have at the beginning of an earnings week, right, when the focus is on those individual stocks. So Bed Bath & Beyond is actually the highest trending ticker on the Yahoo Finance homepage today. And that's not earnings, of course. That's the company declaring Chapter 11 bankruptcy. And the shares, such as they are, I mean, they're 23 cents, but they're down by 22% today. Coca-Cola on that list as well. We're going to talk more about that later this hour. C3.ai, which we talked about getting a downgrade today and down by 10%. And here's a good one. First Republic is up today by more than 5.5%. The bank is reporting after the close of trading today. Remember, it's gotten various rescue funds. There's a lot of focus on it as we try to figure out whether the banking crisis is finished or not. Getty Images as well, up 36% after getting a takeover offer from Trillium for $10 a share. So just goes to show we do have this move on the individual level, but we are not seeing as much sector movement or index movement or large cap non-story movement happening in today's session, Brad.
Certainly. Well, Fed officials, they remain laser focused reining in inflation. But what is the economy saying on the potential future path of the Fed's policy moves? Here to discuss, we've got Abigail Watt, who is the Aberdeen U.S. research economist. Great to have you here with us this morning. Abigail, as we think about how many months a trend are going to be necessary to show a trend for the Fed, I mean, what does that calculus look like to you? And by when could we start to see that actually formulating so that the policy pathway that they've been on starts to pivot?
Yeah, so I think we did see progress, in particular in some of the metrics that the Fed is very focused on in the latest print. We saw shelter prices, which are a very big component of core CPI, coming off the boil a little, increasing by less than they had been. And I do think that's a very positive sign for the Fed, and we expect that those kind of prices will be peaking by the summer of this year. I think what's more concerning is perhaps the non-shelter core inflation. And I think that's the area that the Fed is really going to be looking for kind of further progress before they declare that the inflation issue is kind of dealt with.
And so then what happens as we look to the Fed meeting next week and beyond? It sounds like you think we're at least going to get that increase next week, which is indeed market consensus right now. But then what?
I think it's a really good question. I mean, obviously, last meeting, a lot of the focus was on the stability of the banking sector and how that kind of interplays with the ongoing inflation issues and the fight against inflation that the Fed has. I think this meeting, we are expecting that 25 basis point hike. Our expectations is that this will likely be the final hike in this cycle. I do think one of the things that we're watching really closely is the labor market. Our expectation is that we begin to see the labor market rolling over more significantly. And we do need to see kind of some of those wage pressures coming off the boil as well in order for us to kind of have a very strong conviction in that final 25 basis points at next week's meeting. Ultimately, though, I think the more interesting area in terms of, I guess, contention for the Fed is that cutting cycle, and the market currently pricing around 50 basis points of cuts by January 2024.
Even if this is the final hike in the cycle, it then comes down to what their messaging looks like. What are you expecting there, as the market is going to continue to react to every single word that the FOMC chair, Jay Powell, has to put out there for the markets to ingest and really get a picture of, okay, how is the Fed perceiving its actions have been ingested or digested by the economy?
Yeah, I think it's a really it's always really critical that the messaging that comes out of these meetings is almost as important as the policy decision itself. We would be looking to see, I think, the Fed be fairly balanced at the meeting next week. I think they'll be stressing that data dependence. As you say, they're watching really closely to see how their policy decisions are affecting the real economy, and so I think they'll be watching really closely the kind of incoming data. I do think they'll likely try and push back against the view of kind of cuts that are priced into the market. We actually would endorse those. We're expecting a US recession later this year, and we think that the Fed will have to loosen policy into that. I think the other element that might be interesting in the Fed meeting next week is whether they comment on the interesting insights from the minutes, where we saw that staff at the FOMC actually began to kind of forecast a mild recession in the US off the back of the banking sector turmoil. So that's something that I'm looking for in terms of whether there's any comments around that in the press conference.
And Abigail, how do we know if the recession is here or if it's imminent, right? When you talk about the data and watching all the data, how do we know? What are going to be the key things that you're going to be watching that could potentially be signals?
Yeah, so I think we saw quite a strong set of PMIs last week. I think seeing those PMIs begin to roll over again is something that would be pretty critical to us being in a recession. I think we also need to see kind of the labor market data beginning to roll over. I think if we begin to see kind of slowing jobs growth or outright kind of cuts in jobs in the US economy, I think that's a pretty significant signal that things have kind of tipped into recession. I think one of the other things that is worth watching is claims. We have seen claims ticking up, but they're not yet at recessionary levels. And so those are a couple of indicators that I would expect to turn over if we were in a recession.
How likely is it that consumers are going to be fed up before we even get to a recession? I mean, we've been talking about a recession for north of or at least around about a year now.
Yeah, I mean, I think you can make the argument that there's been somewhat of an industrial slowdown so far. You've seen industrial production being fairly weak, but you've seen the consumer kind of holding up actually reasonably well. It's interesting, consumers generally have been less confident given inflationary pressures, but if you look at the actual consumption data, US consumption has been pretty robust through that period. So I think there's a little bit of a mismatch there, and it could be the case that ultimately you start to see kind of as wage growth is slowing, inflation pressures are still kind of around for those kind of key goods that goods and services that consumers are demanding. You could start to see kind of some clearer slowing in kind of consumer spending, in particular through kind of Q3.
Abigail, thanks so much. Appreciate your time this morning. Abigail Watt is Aberdeen U.S. research economist. Thanks.
Thank you.
Let's take a look at a trending ticker now. It's Credit Suisse. The Swiss bank earned a whopping $13.9 billion equivalent in the first 3 months of the year, while also experiencing significant net outflows for assets under management. This comes after last month's deal of rival UBS acquiring Credit Suisse after its struggles that came amid broader turmoil among banks. Those U.S. shares, they're still trading. The company still reported earnings, which I guess was a little bit surprising, but the shares are up by 2.1%.
Coming up, everyone, candidate fatigue. The most likely scenario for the 2024 election is one most Americans don't want, it seems. So, are there any good options for the public? We're going to discuss that next.
Hollywood is facing its first potential writer's strike in 15 years, but it's not a rerun of 2007. Here's what you need to know. The Writers Guild of America, aka the WGA, represents thousands of television and movie writers. April 17th, the union voted overwhelmingly to authorize a strike if a deal with major studios was not reached by May 1st, the day the Guild's 3-year contract expires. A strike would cause a full production shutdown, affecting actors, stagehands, studio crew, and the biggest companies in Hollywood as scripted series across both network television and streaming grind to a halt. The WGA have been negotiating with the Alliance of Motion Picture and Television Producers, which bargains on behalf of the studios. The talks have centered on pay concerns brought on by the streaming boom, in addition to other fundamental changes within entertainment, like the recent wave of cost-cutting measures, which have included layoffs and scrapped projects. What's different today versus prior years is that many of these studios are not pure play production houses anymore, meaning they have their own streaming divisions as well as their own profitability concerns. And as we know, streaming shows often have less episodes and less residual income compared to traditional network TV, which means less money in the pockets of these writers. Many in Hollywood have weighed in on the potential strike, with Netflix executives directly addressing it during the company's Q1 earnings call.
We don't want to strike. The last time there was a strike, it was devastating to creators. It was really hard on the industry. It was painful for local economies that support production. And it was very, very, very bad for fans.
Netflix said it has a long and robust slate of content in the event of a strike, but executives reiterated that they're at the table and they want to find a solution. It's similar to what we heard from Warner Brothers Discovery CEO David Zaslav, who told reporters he was optimistic a deal could be reached in a way that's fair to all parties. But they're assuming the worst from a business perspective, and also have backup content produced and ready to go if needed. While some analysts have suggested a strike could be good for cash flow since no new content means no new expenses, the general consensus is that a strike would not be good for the industry.
At the end of the day, the street doesn't like the uncertainty that comes with a strike. It's going to just inject more noise as the cadence of new content slows down.
With so much at stake for both parties, the pressure is on to reach a deal, or else the industry faces yet another major blow just 3 years after the pandemic.
Welcome back. There are seemingly no good options for the American public, it seems. A fresh poll from NBC News shows Americans cooling on the prospect of an election rematch between President Joe Biden and former Commander-in-Chief Donald Trump. This as various reports suggest Biden will announce his re-election bid as soon as tomorrow. Joining us to discuss, Yahoo Finance's Rick Newman. People just not psyched about this at all, judging from the polls, Rick.
That's right. I guess if there's any solace here, it's that maybe on the Republican side, things could change. Donald Trump, as everybody knows, is facing mounting legal challenges. The case in New York City, maybe not all that serious in the eyes of many voters, but he's going to have bigger problems coming up. There's a civil case that's going to start tomorrow involving rape allegations against Donald Trump that go back years. That's going to be pretty ugly for him. And then we have this other case in Georgia where they seem poised to charge Trump with election fraud. So, you know, one of the things I think we're seeing is some Republicans are coalescing and trying to get Trump out of the way. We're seeing this among some Republicans in the Senate, for example, like Minority Leader Mitch McConnell. So I think you're going to see a lot more pushback among Republicans to Donald Trump than we saw when he was president. Whether they will be able to push him out of the way and mount another candidate is another question entirely. But there are going to be some Republicans who try. So it's not 100% clear yet that it's going to be Biden versus Trump again in 2024.
You know, it's really interesting and a multitude of things to bring up with you, Rick, here. But first, I'll start with this. I'm pretty sure Trump co-opted the Ryder Cup 2024 logo to use for his own campaigning benefit. I wonder if they'll reach out to him for comment on that. Also here, does it seem like the markets have one way or another decided who they would get behind as well in a run for presidency in 2024? I mean, we are essentially a little over, 20 months or 18 months away?
Well, put it this way. I think markets would be fine with another term for President Biden. And the reason for that is President Biden won in 2020 and Democrats took control of both the House and the Senate We didn't see a big reaction in financial markets to that, even though it was clear at the time that one of the things Biden wanted to do was raise the corporate income tax rate. That clearly would have been a negative for stocks. He also wanted to raise tax rates on wealthy Americans. And markets didn't really care about that once the outcome of the 2020 election was clear. And guess what? Biden was not able to raise corporate taxes, and he was not really able to raise taxes on wealthy individuals. There were a couple of small tax increases when Democrats did control Congress for those 2 years. That didn't rattle markets at all. So I think markets would be fine with another term for Biden. And that the main reason for that is if he wins, Democrats could take control of both houses of Congress again, but they are not going to have a huge margin in the Senate, which means that Biden still probably wouldn't be able to get those tax increases through, even though he would certainly try. So I don't think markets really care that much how the 2024 election goes.
Yeah, and if so, he'd be trying for a second time without Joe Manchin as a roadblock, perhaps too. So that a consideration there. Yahoo Finance's own Rick Newman, a great breakdown as always there for us, Rick. We appreciate it. Guys, coming up, the first real worst study is in for artificial intelligence and the workplace. But how exactly does AI impact workforce productivity? And what are some of the dangers? We're going to discuss that next. Leaders in the artificial intelligence race, such as Alphabet, Meta, and Microsoft, they're expected to announce quarterly results this week, and investors are eager to hear their plans and how they're going to incorporate artificial intelligence tools, as recession fears are causing some execs to focus on productivity. Here to discuss what Wall Street is expecting to hear about AI in the workplace is Prion founder and CEO Igor Yablokov. Prion provides augmented intelligence for companies to use internally, and Yablokov's former company, Yap, was sold to Amazon, and its technology formed the basis for Alexa. All of that considered, sir, what do you expect to hear when these companies report earnings and also give some type of nod to their own artificial intelligence ambitions?
I think we're still early to see any sort of productivity output. Obviously, from their perspective, their job is to provide the picks and axes, especially for these enterprises, and buttress their existing product lines and revenue lines.
It seems like, Igor, a lot of the excitement around the latest wave of generative AI has been consumer facing, right? Because the public got a hold of ChatGPT, people played with it, they were very excited about it. You focus on it more for enterprise. Do you think, while ChatGPT, again, is sort of public facing, if you will, have the companies that have put forth these AI solutions also been working on the back end with companies to sort of offer products on that end? And when's that going to move the needle?
I think in some cases, you're exactly right. They've been taken by surprise in some ways. Most of these experiences do get born in consumer incarnations. If you actually go to the primordial ooze of artificial intelligence, many of these incarnations actually started by trying to support things like accessibility, to put them inside of vehicles, right? So that we don't text while driving, so to impart more safety. And then they mutate into these consumer experiences that all of us know as Alexa, Siri, and these style of things. And once the consumer tech companies de-risk something as an interaction method, then do we start seeing all of the capabilities getting added so that it can go into more robust environments such as enterprises.
Igor, so much of the focus for what has existed within search for decades now is the ability to optimize for search engines. And by that, even on kind of press or media or any type of website that gets put together, there is search engine optimization in order to have your own result ranked higher. As you start to think about the future of search and generative AI and how that is going to pull in data as well, have we heard anything from how these companies are going to make sure that we are protected from either bias or just some type of optimization serving up an answer that may not be correct?
That's a great question. I mean, obviously, as they're trying to support ads-based businesses, one of the things that you have with a search index is rankings, and people are paying to show up on top. Or as you rightfully said, they're trying to optimize their web experiences in order to hit the mark on the search terms that are being looked at. I think with these large language models that are at the core of these new experiences, it's still unknown in terms of how SEO is going to be working in them, if they are able to change any of these outcomes as well. Because remember, these are black boxes, and even big tech folks don't know exactly how these things work yet. And so there's going to be a period of time to essentially stress test these models, ensure that there's no toxic content in them, to see whether they align with existing product lines or whether they just cannibalize and they have to drive new experiences.
So that's talking about some of the potential risks inherent in this new technology. Let's talk a little bit more about opportunities. I was intrigued by this new report of a study out from Stanford and MIT that talked about an uptick in productivity among workers using AI, particularly lower skilled workers or even lower performing workers who were using AI. As somebody who was involved in the sort of precursor to an Alexa, what do you think is the next big move here? What do you think is the big opportunity with this current crop of technology?
And that's why we always talked about it as augmented intelligence. Mm-hmm. I think there's not any strata of job that this isn't going to be effect in corporate America. So we're pretty excited about that. But you're going to see new platforms that are purpose built to task, because the expectations for enterprise environments, especially if they're highly regulated, are different levels of accuracy, scale, security, and speed, right, in terms of how fast they react to markets. And so you're going to see a lot of that want to be more under control of the enterprises themselves, because once they depart their website, where it's simple things like support and help desk style operations, they're going to get closer to their core IP, intellectual property, in terms of what defines who they are as organizations. And I'm not sure how much of those heuristics they're going to want big tech folks to grab as they figure out their own expansion opportunities.
It's really interesting that you mentioned augmented intelligence instead of artificial intelligence. The first time I had heard that was a couple weeks back in one of our conversations with, and full name drop, I suppose, Grand chess master Garry Kasparov, who had mentioned that's how we should be thinking about this going forward. When you think about as well what the delta would look like for a lot of the companies that are saying they're rolling out some type of generative AI component into their business as a pick and axe, as you mentioned earlier, what type of material value would that add from what we can calculate at this point to these businesses?
I mean, we have a relatively large client that's about to adopt this in the energy space, and they're foreseeing that they can reduce the downtime of power plants by half by adopting these style of technologies. So it's fairly material. We're not talking about single-digit improvements in productivity. We're talking about sea changes of productivity that we're on the cusp of.
All right, very interesting stuff as we continue to talk about all this. Igor, thank you for your time. Igor Yabuklov is Prion founder and CEO. Appreciate it.
Thank you for having me.
Coming up, pharmaceutical giants are set to report quarterly results later this week. We preview what to expect on the other side and what's going on in healthcare writ large.
Siri, what is metadata?
So you want to know about metadata? Of course you do. It's come up in a lot of conversations, especially around some of the social media hearings that have taken place on Capitol Hill. So what is metadata? Metadata is essentially the data about data. And to break that down even further, say you post a picture. That picture, even when you've taken it, already has the location that that picture was taken at, the date that it was taken, the type of camera that you were probably using. Those three things and more amass the metadata. But here's where it comes into play for some of the social media companies, is because when you post that image, you are essentially giving that metadata over to the social media companies, and you're allowing them to then catalog some of that metadata and create an advertising profile on you that they can then index and be able to resell to other advertisers. So for social media companies, that metadata is incredibly important. There's some data that you volunteer when you sign up for a profile, but there's other data that you're giving them not even knowing it. And that is how you get advertised to on such a granular level, and why some of those ads are so relevant. I missed the cup.
It's not just tech this week. Pharmaceutical giants like Eli Lilly, Merck, and AstraZeneca are set to report their quarterly results this week as well. Joining us now to weigh in on the healthcare trends investors should be watching ahead of these reports, as well as the IPO of Johnson & Johnson's consumer unit, Kenvue, is Megan Fitzgerald, private equity investor and professor of healthcare policy at Columbia University. Megan, it's great to see you. It occurs to me, and this is something that you sort of mentioned in your notes as well, that we are now obviously moving into the post-COVID period, and that goes for these healthcare companies as well. So what does this next phase look like for these companies, and what should investors be focusing on?
Yeah, I think if you had a strong balance sheet and you were diversified, you're sitting really well. We saw last week UNH, United Health, had a blowout report, mostly due to Optum. So they are very diversified there. CVS is looking good. Elevance added 1 million new customers and $2 billion of profit. So I think what you're seeing, if you depended on COVID testing, COVID funding, and COVID shots, that's pretty much dried up. But if you had new business into primary care, care in the home, Medicare, Medicaid, you're sitting very strong. I think that's what we saw in that sector last week for sure.
One of those names that's at the top of this healthcare stocks board that we're looking at right now, J&J, they are set to move forward with their consumer health division IPO. What are some of the details we know about that? Do you expect the market to react positively to that and receive this division well as a standalone?
Yeah, great question. So here's the puts and takes. One, I would call that more of a corporate carve out, not an IPO. We're seeing that with Baxter spinning out their renal division, LabCorp spinning out their Covance division under the name of Fortrea. These are well-established businesses with high revenue and high profitability. I think Kenvue's $15 billion in revenue last year, $2.1 billion in profit. So that's not really a de novo IPO. This is a well-established business. Kenvue has some of the greatest brands in the world, Tylenol, and a bunch of consumer brands we all know and like and are very familiar with. So I think this will certainly be a beacon and a bellwether for all the others that are doing corporate spinouts, and there's a lot of them. I think the challenge for this is Kenvue is looking to raise more than has been raised to date. I think they were looking to raise like $3 or $4 billion, or maybe even more. And to date, there's only been $2.3 billion raised. So I think the challenge is the amount they're raising and that it's been a relatively quiet IPO season. However, I think most of the spinouts and carve-outs have done better than de novo IPOs. So that's how I would size that up.
You know, it's also been quiet relatively in terms of deal activity, but pharma's and healthcare's kind of an exception, right? We have seen some deals happen there. What is this year going to look like on that front, and where are the opportunities for investors?
Yeah, I think I shared with you this morning. Last week was the third highest for M&A and biotech that we've seen in a really long time. I think $61 billion of M&A activity hit the tape in the last 2 months. So it's hard to believe we're talking about a potential recession later on in the year, but yet we might have a record year for biotech deal making. Important to note for fair balance, most of those deals are in late stage, phase 2, phase 3. So a lot of the risk has been drained out of those deals. So anyone buying is paying at a premium, as we saw with Pfizer and Seagen, and they're buying for a pipeline that's pretty much on the market. They're not taking too much risk to wonder whether these are going to be FDA approved portfolios. So I think interesting times ahead, Julie. I think too soon to call it, but biotech's starting to look like it's going to shape up to be a decent year if you have late stage assets or you're well funded and you have cash. There's a whole bunch of other companies that will start to look like zombies because they're too early stage and they can't raise any money.
Does that consolidation create an environment where healthcare is safer at the end of the day? And I ask that because we've thought about this digital transformation and how it's impacted so many industries, but healthcare from a cybersecurity perspective has still been one of, if not the most vulnerable. So has there been any better securitization of the data that all of these companies are going to amass in one way or another about consumers?
Yeah, I think it's a totally fair point. Certainly cyber is a big risk, and we've had enough high profile hospital and payer systems that have been, held ransom for their data. However, that hasn't spooked investors enough to steer clear of it. And I think most people would say, Healthcare is not recession proof, but it's certainly recession resilient. And therefore, during downturns and recessions, people tend to flock to healthcare. 60% of the payer is still the government and commercial payers, and people still need healthcare. And we're not seeing a slowdown, at least from my perch volunteering across the street at the hospital. Patients are still coming in. There's still a backlog of surgery. There's still people that have multiple chronic conditions that need care. So I think healthcare, it's rightly labeled as resilient proof for sure, and certainly a defensive sector.
Yeah, and I know you have a lot to say about the shortage of workers in the industry too, but we'll get that to another time. Obviously, you're pitching in to do your part, as you just said, Meg. I want to take a little bit of a left turn finally and ask you about these hunger control drugs that have become all the rage. And investors are showing a lot of interest in them too. Novo Nordisk, which makes Wegovy, is the one that has gotten so much attention. What do you make of this trend? Is it sustainable? Is it something investors should be chasing?
Yeah, I mean, an interesting stat is 3 companies that captured the most value, enterprise value in pharma. 2 of the 3 had obesity products. So what does that say? I mean, these are products that are going to be $40 billion a piece, if not more, because the population is so huge. Half the American population is technically overweight. Prediabetes is a real thing. So I don't think these drugs are going anywhere. I think the big concern right now I'm hearing, Julie, from a public health perspective is a lot of younger patients are starting to go on these, and we don't really have more than 2 years worth of data. So we need long-term data to really find out, now that these drugs are in the real world, what they really do and what the side effects are. And I also think there's a concern that people that don't need to be on them are on them. So I think the jury is still out on that, but it's just an enormous TAM, one of the largest. So I don't think in terms of performance, revenue, and profit, there's a reason Novo and these companies are doing very well, and it's because of these medicines.
Megan, always really great to speak with you, and thanks so much for the time, really breaking down a ton of what we should be watching over the course of this earnings season, but more broadly across the healthcare landscape. Megan Fitzgerald, Columbia University professor of healthcare policy and private equity investor. Thanks so much. Coming up, everyone, Coca-Cola topped Q1 expectations. We get a vibe check from the earnings call and break down the company's first quarter numbers. That's coming up next. This morning, we are watching soda or pop, wherever you're in the country. You may be pronouncing it differently, but Coca-Cola is how we pronounce it here on set, rising on a first quarter earnings beat driven by price hikes despite consumer belt tightening with surging growth in Asia as well. Here with more, we've got Yahoo Finance's Alexandra Canal. Allie, you've been listening in to the call here.
Yeah, I was able to listen in on this call this morning. I would say the vibes were good vibes overall. They were high, especially compared to some of these other calls that we've listened to. And a big factor for that was the fact that we did see this earnings beat, a beat on both the top and bottom lines, double-digit organic revenue growth, which is an important metric for these types of companies. And that was largely driven by price increases offsetting inflation. Now, pricing overall, that was a key takeaway and emphasis from this call is pricing. It doesn't seem to be denting demand, especially in emerging markets. If we look at unit case volume overall, they were up 10% in Asia Pacific region, 5% in Latin America, although North America, we do see that flat, with Europe, the Middle East, and Africa region down 3%. So the global story, the global opportunity, a big one here for Coke. Another key takeaway for me centered on the wide range of brands within that portfolio, from juices to water to soda, and again, the global opportunity to capitalize on these brands despite various economic headwinds. And on that front, Coke executives did say there's certainly uncertainty about the operating environment ahead, but that there are signs that some of those pressures are abating. So here's a bit more of what CEO James Quincy had to say.
In the first quarter, pandemic restrictions in parts of the world relaxed and many supply chain pressures abated. At the same time, inflation and geopolitical tensions persisted, and new concerns emerged around the stability in the banking sector and the magnitude of the potential squeeze on consumers.
So a cautiously optimistic tone there. There are uncertainties, but Coke really reiterating that they're at a point that they can pivot pretty easily to adjust for that and make up ground on that front.
Yeah, Allie, thanks so much. Appreciate the after the call take there. So let's talk about also what the Wall Street takeaway is. Consumers generally don't like to see higher prices. What effect does that have on spending, et cetera? Whether Coca-Cola can bottle up Wall Street enthusiasm. Gerald Pasquarelli, Wedbush Securities SVP of Equity Research, is here with us now. Gerald, what's your take on the company's numbers? I have to admit, I was surprised with higher prices, still saw an increase in those case volumes.
Sure. Well, thanks very much for having me. I think when you look at the start to the year, it was a very good print for Coke. I look at this largely as a continuation of what we really saw over the vast majority of 2022, where outsized price mix is driving above algorithm revenue growth for Coke, for peers. Non-alcoholic beverages is just a category that has been very strong. And this outsized pricing is really helping to offset outsized levels of commodity inflation. I think you're seeing that flow through to not only top line beats, but also earnings beats. And so Coke, as a bellwether for kind of what to expect for this earnings season, we thought it was very encouraging.
Is there a top fizzy drinks pick from the Wedbush or the broader kind of analyst viewpoint right now when you think about the consumer environment, where consumers are still willing to take price, and the product mix that a Coke might have versus a Pepsi or even a Nestle more broadly here across the landscape?
Sure. So in soda, we're actually recommending all three companies. We're recommending Coke, we're recommending Pepsi, as well as Dr. Pepper. We also recommend a company called Celsius Holdings. They're smaller, kind of a disruptive energy drinks company. That's our top pick in the space, but we think that from what we've seen in terms of consumer resiliency and continued earnings beats for most of these companies, we remain constructive on the broad space. We think these are grind higher stocks, and we think today's earnings results for Coke certainly speak to that.
And so when we look at these Coke results, and when we look at, as you said, the read through to the rest of the industry, I'm also curious about what's happening on the cost front, right? Because we see these prices continue to go higher for consumers. Is Coke feeling that same pressure in its input costs?
So it was for sure back in 2022. And I think that when you look at where these companies are guiding, all top line guidance essentially is implying a deceleration relative to what these companies did in 2022. And so embedded in that assumption for decelerating revenue growth is that you're going to see moderating levels of pricing as we progress throughout the year. And that's going to come in tandem with a better cost outlook, certainly relative to what we saw last year. So you're going to have pricing coming down. At the same time, you're going to have many commodity input costs that are moderating. And so that is ultimately what is going to protect bottom line profitability. Double-digit pricing is largely unsustainable over the long term. And so when you look at the cadence of kind of what to expect for Coke and then what to expect for their peers, the 11 points of price mix that they delivered in 1Q was largely carryover pricing from pricing actions taken in the fourth quarter. That likely flows through to 2Q, and then you probably see it start to moderate in the back half of the year.
And Joe, I've heard the term excuseflation bandied about a little bit in this current cycle, right? That like the companies, they're going to take as much price as they can, even if their costs are not going up at the same rate. Is that starting to happen within the beverage industry in particular? And at what point do consumers say, wait a minute, and start to push back on that?
So I think the broad outlook is companies will always take as much pricing as they can.
Sure.
As kind of an intra-quarter read that we use and that many sell side analysts use, we rely on Nielsen or IRI data. And what we've started to see in carbonated soft drinks, which is obviously Coke's most important category, pricing remains very strong, but volumes, the volume declines have actually become more pronounced. If volumes were kind of flattish to down low single digits, over the past couple of months now they're down mid-single digits. And so you may be seeing early signs of just a prolonged impact to the consumer's ability to absorb these price increases. And so that's something that we're certainly going to continue to monitor over the next 3 months as we really try to get a read on what to expect going into the second quarter. So I think there's going to be more to come on that. But when you're talking about staples and you're certainly talking about soda or salty snacks, these are very much need-based categories that are on the broad spectrum of things, lower priced relative to other categories, right? So I think that gives these companies some more protection to be able to price through some of this outsized commodity inflation.
Do you think that we're going to see any additional consolidation, kind of beefing up of the catalog of products that these companies hold on to right now? I mean, even when we were parsing through Coca-Cola's results, it's a reminder of how much acquisition's been necessary in the coffee business, in the sports drink business, and even into the soft drink business as well, in tandem with what had already been their kind of patented ingredient for decades, right? And so all of that considered, do you think we're going to see a little bit more of an M&A type of landscape for some of the beverage companies?
I think that there's always the potential for bolt-on M&A to enhance your overall portfolio in areas you may under-index to. When you look at current categories that to us look interesting, sports drinks looks like it's a category that's kind of being disrupted by some smaller competitors. I know Coke had the Body Armor acquisition, which they're kind of continuing to incorporate into their portfolio. But I don't know that it's going to be M&A on a large scale. I think it's going to be ways to just enhance a portfolio by looking at where you either over-index or under-index relative to peers and trying to figure out what the most optimal mix to drive the most sustainable revenue growth will be.
There's a specific drink I want to ask you about, Gerald, and that is Starry, which is the new Pepsi drink that replaces Sierra Mist, sort of has a retro-looking can. How's that going to do for them, do you think?
So if you look at Sierra Mist, it was, and I've actually gotten more questions on this than I would have thought, but Sierra Mist is almost a non-meaningful part of Pepsi's portfolio. It was less than 1% of revenue if you look at scanner data. And so I think when you look at the broad strength that we've seen in citrus flavored soda offerings, I think a brand refresh makes sense for Pepsi. Sierra Mist kind of was in the market for a while. It didn't really seem to gain the necessary traction that Pepsi wanted it to. And so for them to come to market with a new product to try to maybe go head to head with a Sprite or with some of these other high growth products that are doing very well makes sense to us. But as of now, it's a negligible, they're going off of a base from Sierra Mist that was almost a negligible part of their portfolio.
Have you tried it yet? The Starry stuff? No.
I have not.
We'll have to do a taste test. Gerald, thanks so much. Gerald Pasquarelli, Wedbush Securities, SVP of Equity Research and Beverages. Appreciate it.
Thank you.
Coming up, we're going to check in on some trending tickers ahead of the 11 a.m. hour and get you set for the rest of your trading day.
Earnings, and more earnings. It's a big week ahead for investors. All eyes focused on the tech titans lining up with their latest earnings report. Here's what you need to know. First up, it's a doubleheader Tuesday with Alphabet and Microsoft set to drop Q1 financial results after the close. Alphabet investors will be watching for details on the company's AI investments, while Microsoft shareholders want to know if Microsoft Teams has acted as a tailwind for the company's growth. Next up, Meta. The company formerly known as Facebook will report first quarter earnings on Wednesday. While Meta has been making headlines with the latest round of layoffs, investors are likely to keep an eye on the company's monthly active users and its new strategy, the growth of the metaverse. And rounding out next week, Amazon will report on Thursday after the close. The company recently joined in on the AI race, but will their bet on artificial intelligence pay off? Investors will be listening for AI mentions on the call. We will have all that covered on Yahoo Finance, and tune into After the Call Tuesday, Wednesday, and Thursday with a breakdown of the big tech earnings calls.
And before we go, let's wrap it all up with the big things coming up today on Yahoo Finance Live. First, the White House just held a summit all about 6G. Yes, 6G. So who's ahead in the race to develop it, and how far away are we from it? Rochelle Akufo is going to be joined by President Biden's top cyber official to discuss at 11:45 a.m.
Ooh, looking forward to that. Plus, Coca-Cola just reported results. So what did we learn about the state of the consumer? A whole lot. What about the impact from the dollar? A little bit. We'll take a deep dive inside the report in just a few minutes.
And later, Bed Bath & Beyond filed for bankruptcy. But what does it all mean for shareholders and the broader retail space? Our 3 to 5 show is going to dig deeper into the topic with the former CEO of Toys R Us and the Associate Dean of the School of Law at Arizona State University. So stick around. That's coming later in the day.
All right, approaching the top of the 11 a.m. hour. Major averages right now, they are mixed. The Dow flat just barely to the upside by a hair on its chin. S&P 500, you're seeing that down by about 0.1%. Nasdaq Composite, you're also seeing that in the red as of right now by about 0.5% on a big week where we're going to be waiting for some earnings to come across. And on the sector front, if you're looking at technology right now, it's one of the biggest decliners, really only being beat by real estate on that front. But you do have more advancers than decliners right now, led by energy and health.
Yeah, and on the flip side, the thing that's getting my attention today is First Republic Bank is just ripping higher ahead of its earnings report after the bell. Right now, it's up about 12.5%. So definitely some enthusiasm coming in ahead of that bank's earnings. We'll see if it can live up to those expectations when it reports.
We teed up big earnings reports over the course of this week. We've got after the call throughout the week as well. You've got a little bit of time to wait, though. In the meantime, Rochelle Akufo has you for the next hour of trading. Here's a live shot of New York.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Results season hasn't given investors much to hang their hats on. This week, tech takes over with Microsoft, Meta, and Amazon reporting. Coca-Cola, though, the standout today. Price hikes fueling a strong beat. And House GOP leaders seem confident Speaker Kevin McCarthy's bill to raise the debt ceiling will pass the narrowly held chamber, but is a repeat of 2011's drama even more likely? We'll discuss. And the race to secure key infrastructure heats up, and 6G is the next battleground. Reports suggest China will open mobile applications early, so where's the US in all this? We speak with a key voice. But first, let's check in on how the major indices are faring as we head into an hour and a half of the trading day here. A mixed picture here. The Dow just barely in positive territory, although gaining a little bit of ground here, up just about 15 points. The S&P 500 still off its session lows, but still down there just slightly about 5 points. Similar situation for the Nasdaq, down 0.5% though. That tech drive heading down there, as you can see, down 0.5% on the day, still digesting a lot of these heavyweight earnings and bracing for big tech's big week. Let's also check in on the Treasury market. See how the yields are faring this morning. As we can see here, short-term yields here down about 1.5%. The 10-year also down in similar territory, about 1.5%. Longest 30-year yields, they're down about 1.33%. Well, turning to our top story, Coke keeping its fizz with investors on earnings, while Procter & Gamble last week also staying positive despite reduced consumer spending. The trick lies in overseas selling. Here with how the dollar is affecting earnings, Yahoo Finance's Ines Ferre. Hey, Ines.
Hey, Rochelle, that's right. And P&G and Coca-Cola, they're both consumer-facing companies which beat revenue and earnings expectations despite still seeing foreign exchange headwinds. Now, why is the U.S. dollar important when looking at multinationals? Because these companies sell abroad as well as the U.S. So the products they sell outside the U.S. are sold in local currencies. And if they are weaker than the dollar, then sales booked in non-U.S. dollars are worth less. So when we look at the dollar index, the DXY, for example, that's the U.S. dollar against a basket of other currencies, it's still sitting at multi-year highs. So even though it has pulled back, we have seen a pullback this year, then, well, it's still at historical high levels. And in its earnings call last week, Procter & Gamble management said, we continue to expect more volatility in the macro and consumer environment and expect sustained pressure on costs and foreign exchange as we move forward. When it comes to Coca-Cola, executives in their earnings call talked about some FX headwinds similar to Q1 throughout the year. Now, meanwhile, Apple will be reporting next week, and earlier this year, the iPhone maker said unfavorable foreign exchange rates were a challenge for the fourth quarter and said that revenue actually increased when adjusted for currency fluctuations. So the strength in the U.S. dollar has been repeatedly mentioned by other multinationals in the past, like IBM, like Caterpillar. And for this year, FX analysts have been forecasting a weaker dollar if the Fed stops raising rates. But then a global recession could prompt a flight to safety, so that would support the green pact, therefore also impacting multinationals. Rochelle.
Definitely expecting that theme to keep showing up throughout this earnings season. Thank you for that update, Ines Ferre, there for us. Thank you. Well, back to the bonds. Hedge funds are betting on continued market strength, but with longer-term yields still discounted compared to short-term counterparts, some analysts are hoping to play both offense and defense in their portfolios. Joining us now, Mike Kudzil, PIMCO Managing Director and Portfolio Manager. Good to have you on the show, Mike. So how do you play then bonds, both offense and defense?
Great question. Thanks for the time today, and appreciate being on the show. We think about bonds from an asset allocation perspective. You know, fixed income is as attractive as it's been in 15, 20 years. Real yields are positive 1.25% to 1.5%. It was just 16 months ago that there was negative 18 trillion of negative yielding debt across the globe, and now there's nothing left with negative yields on it. So, from an asset allocation perspective, fixed income is quite attractive. If you look at diving into the yield curve a little bit further, front end yields are, again, also quite attractive. If you can get a 4.5%, 5+% return on cash, we think that's something that's starting to attract investors. Looking at flows, it's also quite attractive. And then the further out the yield curve, there's something for everyone. The yields are slightly less the further out you go, but you also get the potential for capital appreciation, which we think, again, in a portfolio context, makes a lot of sense. So looking across the yield curve, something for everyone, and we find fixed income, quite attractive in this environment right now.
So then, with an eye on a potential Fed pause at some point, how should you be looking at this, especially since we're wondering how long these yields can stay this high?
Yeah, I mean, the market's pricing in for one more hike in May, almost a certainty, and then the Fed to almost begin cutting immediately. So markets have cuts priced in, 50 basis points of cuts priced in by the end of 23, another 140 basis points of cuts priced in by the end of 24. So, again, whenever the Fed's done hiking, markets are always going to price in cuts, and the amount of cuts will depend on just the strength of the economy and whether or not the economy holds up or whether something more nefarious happens. And so that remains to be seen. The Fed will respond to the data. And, in our base case, inflation's coming down. The economy's slowing. More likely than not, there's a recession on the horizon. And this banking turmoil that's been discussed here and everywhere certainly has the potential to have more meaningful consequences on economic activity.
So then for people who, sort of been sitting on the sidelines waiting to enter the bond market and they want to enter it now, what sort of environment are they walking into now versus last year?
Well, again, last year yields were extremely low and real yields were very negative. So at the beginning of last year, the aggregate index yielded 1.5%. Now the aggregate index yields 4.5%. The return on your cash was 0 last year. Return on your cash is 5% now. So, depending on investor outlooks, cash is an attractive alternative, and so is the long end of the yield curve. Duration is, again, yields a little bit less than cash, but offers that capital appreciation, diversification, and income in a portfolio. Really, those three legs of the stool that you like to see in fixed income, where none were available last year, and all three are available this year.
And of course, all bonds are not created equally. I want to take a look at some of the different sort of securities that you liked in terms of asset-backed securities, mortgage-backed securities, MBSs. How are you playing those in this environment?
It's a good question. Again, with the base case of a mild recession and potential for something more severe, depending on the outcomes of the banking crisis. We have an underweight to investment grade corporate credits, just generic investment grade corporate credits. And with that, we reallocate into sectors that are AAA rated, extremely liquid, securitized, and up the capital structure. And we think in an environment with slowing growth and slowing inflation, it's a resilient way to build portfolios and allow us to play offense if and when disruption occurs.
And so to that point, then, what would you say are the top three risks, then, if you're deciding between short and longer duration bonds at the moment?
Yeah, so, obviously, when you're investing out the yield curve in duration, the risks are whether or not a recession occurs, whether or not inflation comes back down the way markets and the Fed anticipates. And so from that perspective, if inflation were to stay around longer, if the economy were to prove more resilient, long end yields could move a little bit higher. Having said that, because of the starting valuations of long end yields, you can sustain a 65 basis point sell off or 0.75 of a percentage point and still have a positive rate of return. So that makes fixed income more attractive and gives you a cushion starting valuations. In terms of front end valuations, obviously, you do get a 5% return on cash, but you have that reinvestment risk. If yields come back down, if the Fed starts aggressively cutting rates for a whole host of reasons, you'll have that 5% return for a very short period of time and then need to roll over your cash and reinvest in much lower yields. So again, it depends on investor outlooks. We argue for portfolio diversification, not having all of your cash in one particular area of the yield curve, but finding value in all parts of the yield curve.
So it's certainly important to stay balanced here, but clearly a lot of opportunities out there for people to still get into the bond market. A big thank you there, Mike Kudziel, PIMCO Managing Director and Portfolio Manager. Thank you for joining me this morning. All right, coming up, House GOP leaders seem confident that Speaker Kevin McCarthy's bill to raise the debt ceiling will pass the narrowly held chamber. But is a repeat of 2011's drama even more likely? We'll discuss next.
Earnings, and more earnings. It's a big week ahead for investors. All eyes focused on the tech titans lining up with their latest earnings report. Here's what you need to know. First up, it's a doubleheader Tuesday with Alphabet and Microsoft set to drop Q1 financial results after the close. Alphabet investors will be watching for details on the company's AI investments, while Microsoft shareholders want to know if Microsoft Teams has acted as a tailwind for the company's growth. Next up, Meta. The company formerly known as Facebook will report first quarter earnings on Wednesday. While Meta has been making headlines with the latest round of layoffs, investors are likely to keep an eye on the company's monthly active users and its new strategy, the growth of the metaverse. And rounding out next week, Amazon will report on Thursday after the close. The company recently joined in on the AI race, but will their bet on artificial intelligence pay off? Investors will be listening for AI mentions on the call. We will have all that covered on Yahoo Finance, and tune into After the Call Tuesday, Wednesday, and Thursday with a breakdown of the big tech earnings calls.
It's that time again. Let's debate over the debt ceiling. House Speaker Kevin McCarthy's thin majority in the House comes into focus this week as he attempts to pass a bill to raise the debt ceiling in exchange for cuts to spending. But is this all 2011 all over again? Joining us now to discuss is Yahoo Finance's Rick Newman, the first big test here for Kevin McCarthy.
Right. And the big question this week is whether this Republican bill that would end the debt ceiling impasse for about a year can pass the House. Let's call it 50-50 chance that Republicans can agree on this bill. And because Republicans have a very narrow majority in the House, they need basically all Republicans except for 3 or 4 to vote for this. So that's the first question. Can Republicans pass their own bill? And then we get 2 other ways this could go. If they can pass the bill, then Democrats are going to have to respond somehow. There's no chance that Democrats who control the Senate will pass the Republican House bill. But if the Republicans can show some unity and show that at least they can pass their own plan, then Democrats are going to have to respond with a plan of their own. And that could lead to some negotiations. And we have not really seen any negotiations at all so far. If Republicans cannot pass their own plan, then we are back to a state of chaos. And that would even raise some questions about whether Kevin McCarthy can remain as House Speaker. So we're going to get just a little bit more clarity this week. We're not going to get a resolution to the whole debt ceiling standoff, but we're going to get a little bit more clarity about what comes next. So that is the best we can hope for by, let's call it, Friday afternoon.
So then is more riding on the Republican side being able to show that united front versus, say, if they are able to pass it, does it put the Biden administration in a more difficult position then?
I mean, I think in the bigger picture, it's important for everybody to keep in mind here. We could easily Congress could easily just raise the debt ceiling. There's no reason Congress can't raise the debt ceiling and we could just put all this away, which has happened many times in the past. This is all about politics and about messaging and about optics for the 2024 presidential election. Republicans, as they have done before, when they are the opposition party that does not control the White House, trying to show that they care about the gargantuan level of federal debt, even though they have contributed to that debt by cutting taxes and making the deficits larger than they should be. So this is entirely about politics. This is not about a real problem in the borrowing markets or the funding markets or anything like that. And what I'm seeing analysts start to say is it's going to take some sort of market turmoil to get the politicians to resolve this thing. I mean, everybody wishes it didn't have to come to that, but that's where we are. So if you start to see the stock market slide because of worries that this is going to cause a default, that might be the very thing that gets these jokers in Washington to solve this problem.
That bad news might end up being, I guess, good news for the economy in the long run. A big thank you there to our very own Rick Newman. Sad to see it, but here we are. All right, well, is COVID no longer a story? Not if you saw what was trending on Weibo this weekend. It was the most searched term on fears of a new wave, and China's drug makers reacted in kind. Joining us now to discuss is Yahoo Finance's Anjali Kemlani. Hi, Anjali.
Hey, Rochelle. You're right about that. Really seeing an uptick in the concerns of potentially another wave in China just after they came off one in December. But we want to note that the trend right now in terms of the cases and the testing that China is monitoring does not match anything just yet. They've reported 1.7% positivity rates of those tests that have been taken. About 2,000 cases is what they're seeing. By comparison, the positivity rate back in December when that last wave hit was 29%. So just to give you some context there. Of note, they're monitoring now 12 new variants in the country. One of those is the XBB.1.16, which has caused some concern in India, bringing back masks and seeing an increase of cases. The World Health Organization just calling this variant a variant of interest. And that, just to put in context, is more like a person of interest versus a prime suspect. So that's where they're watching it right now, saying that it does cause more cases, but not clear yet if it's going to be more severe on the disease side. All told, to your point, definitely some of those drug makers' stocks benefiting from this news, including one of the companies that made the molecule for Merck's molnupiravir. But all told, still something to watch for the country. The Chinese CDC saying that it doesn't expect a wave to hit until maybe around September. So that's where things stand right now.
And do we know, is there any indication of how big of a wave that might be, to sort of temper expectations at this point?
Well, just to give an example of the XBB.1.16 concerns, World Health Organization just watching that in the U.S. alone, it's already in about 18 states, but we don't seem to be hearing much about it. The CDC is tracking about a 10% prevalence of it among the variants that are circulating. So to the point you made at the beginning, it's still something to be mindful of. We're not out of the woods just yet when it comes to this. The CDC saying, the Chinese CDC saying that they don't expect a huge wave to hit unless a new variant pops up, and it's currently affecting mostly those who did not previously get infected or are vaccinated.
Certainly worth keeping in mind. As we keep saying, COVID, we're not out of the woods yet, but definitely worth staying on top of these updates. A big thank you there. Yahoo Finance's Anjali Kemlani. All right, stay with us. Coming up on the same page, hedge funds place their biggest ever short on benchmark treasuries. So are they no longer fighting the Fed? We take a bird's eye view of the financial system next. Time now for our chart of the day. We're watching hedge funds this morning, betting on the strength of the economy. Short calls on treasuries are hitting records in April. This is the 5th straight week net shorts saw a rise, according to Bloomberg. The moves mean hedge funds are hoping for an upswing in equities, implying confidence the US will sidestep a recession even as interest rates remain high. All right, well, let's take a look at the 2019 decision to loosen rules for mid-sized banks. That created a loophole that may have masked some recent losses from SVB. And moving forward, any decision to close that loophole could have some major impacts on regional banks. For more, we welcome in David Cass, University of Maryland finance professor. Good to have you on the show, David. So I first want to start with this loophole, because this is something that the regulators are considering here, something that they loosened, and it has to do with how banks report the losses on the securities they have on hold. Break that down for us and what this could mean then for regional banks.
Yes. First of all, thanks for having me. What the rule had been loosened earlier was for securities, long-term securities, for example, held by banks, long-term treasuries, mortgage-backed securities, if they had a loss, an unrealized loss in securities, and they were below a certain size in assets, they were not required to basically mark the securities to market, which would have resulted in a reduction in their capital and the capital buffer that they use and report to regulators and the public. And because they had this exemption, they received an exemption as a result of legislation in 2019, which was then enforced or implemented by the Federal Reserve. This loss, unrealized loss that they had, was pretty much hidden to some extent. And what proposals are being made now, both in Congress as well as at the Federal Reserve Board level, is to sort of increase the level of bank assets in which this reporting would be essentially marked to market, that these companies such as SVB, which incidentally at the end of 2022, its assets totaled $209 billion. It's sort of at the lower end of the mid-sized regional banks, but this would change the measurement of the unrealized capital gains, have it incorporated into their capital calculations, which would then make any losses, unrealized losses, certainly more visible to all.
So then if they were successful in closing this loop, if they were successful in closing that loophole, then what would that look like in reality then for other regional banks?
Yeah, other regional banks right now, looking forward, what's being proposed now, other regional banks who are now with assets below $700 billion, one of the cutoffs, would now have to mark to market basically their unrealized losses in the long-term securities, which would reduce their capital. And this would basically reduce capital for such mid-sized or regional banks, such as U.S. Bancorp, Truist, Capital One, and PNC, to give examples looking forward.
So then, I mean, in the Wall Street Journal article, you said that one way of making banks safer for the whole economy, because obviously there was that concern about the contagion for the rest of the economy, was to ensure a larger capital buffer. How exactly do you do that, and who ends up footing the bill for that in the long run?
Well, this could be implemented by regulation and by Congress, and the implication of a larger capital buffer for banks, but it would be safer for the banks and the economy. It would be less likely that any bank would fail. But banks would basically be tightening up their lending standards. And there would be could be a possible credit crunch in the sense that smaller companies doing borrowing are more likely to go to smaller regional banks, especially those companies located outside of large cities, and they may find it harder to obtain loans and perhaps at higher interest rates than the case before. So the implication is there's a trade-off here. On the one hand, we'll have safer banks, less likely to fail, but on the other hand, the banks will sort of be being required to have more capital, a greater capital buffer, will be lending out or investing less money, and therefore their profits would probably decline over time, and that could, for example, result in a reduction of stock buybacks for shareholders of those companies. So certainly profitability might be expected to decline, and again, for the economy in general, it could be harder for smaller and mid-sized businesses to obtain loans going forward, which in turn would slow down the economy, although this would be working in parallel with what the Federal Reserve is trying to do to reduce the rate of inflation in the economy down to their target of 2%. So this slowdown or reduction in loan demand or loan availability would actually complement what the Federal Reserve is doing in this area.
And depending on how much we see that tightening with the credit crunch, could essentially act as another rate hike. A lot of people have been wondering about that. Now, as we look at the Fed's inflation targeting and we look ahead to some of big tech's earnings, then how does this picture play into how we might see that reflected in big tech earnings and equity markets? Then, being that we do have this convergence of issues at the moment.
Yes. Well, so far, what's interesting is so far, the large tech companies, the largest four are Apple by market capitalization, Apple, Amazon, Alphabet, and Microsoft have outperformed the market this year. For example, Apple and Amazon are up about 27% year to date, and Alphabet and the other one that's skipping my mind at the moment, have been up about 19%. And the overall market, Nasdaq has been up 15% year to date, the S&P 500 7%. So the leading tech companies have certainly outperformed the market, and they are forward-looking in their prices. But certainly with the Federal Reserve raising rates, reducing demand, this would put somewhat downward pressure on earnings of these companies. And this has led to layoffs at many of the large tech companies. And so there would be some reduction in profitability and profits in the near term. But I think long term, the outlook for the large tech companies is very good.
And we'll continue to track those layoffs as we look at next earnings season as well, to see as those things sort of play through the system. A big thank you there to David Cass, University of Maryland finance professor. Thank you for joining me this morning. All right, coming up, the race to secure key infrastructure heats up, and 6G is the next battleground. Reports suggest China will open mobile applications early. So where's the US in all this? We speak with a key voice next. Top Biden administration officials, along with lawmakers, business leaders, academics as well, gathered last week to discuss 6G technology. Joining us now to discuss these advancements and the potential rollout, Ann Neuberger, Deputy National Security Advisor for Cyber Emerging Technology. Thank you so much for joining us this morning. So, Ann, this major event hosted by the National Science Foundation, talking about laying the groundwork for 6G here. How does the US plan on leading and laying this groundwork for 6G?
President Biden is very focused on ensuring American leadership in technologies, particularly those that are core to our economy, our national security, and to ensuring every American has the access they need to compete for jobs and to be successful. So the goal of this workshop, as you noted, bringing together universities, private sector, and policymakers, was to talk about how we get the technology and policy right to ensure that we can lead in this space. And I'm happy to give some examples on why this is such a core technology.
And we certainly will get to that. But a lot of people are wondering, a lot of people are still getting to grips with 5G. So who at the moment then is leading in 6G? Is it the US or China?
So 6G, fundamentally, we are at the research and technology phase where we're thinking about how artificial intelligence, for example, can help us bring together data to build more power-efficient sensors and components. We're thinking about how spectrum and standards decisions and how we engage in those from a policy perspective can, to your point, ensure American leadership. So the jury is still out on how 6G will look. We know it'll be that combination of AI, sensors, and innovations in both spectrum and standards. And that's why it's key to engage now, bring together the core stakeholders to ensure that America can lead in this space.
And for people who are still sort of getting up to speed with this, I mean, we know that 5G, the last iteration, was built on the Internet of Things. And you mentioned 6G will also include things like AI. So in reality, for people watching this sort of convergence between the human, the physical, what we're seeing with 6G's potential here, what are some of the advances as well as the risks that come with it?
To your point, I'll make it real. When we think about COVID, we often think about the opportunities for different families around America. So you had kids who couldn't access their school remotely. You had people who couldn't work from home effectively because they didn't have fast, effective internet access. So to your point on opportunities, we're seeing examples where in the mountains of South America, where in the past, folks had to carry cement on the backs of mules to build cell towers at the tops of mountains in rural areas. Today, because of more using data and using AI, we can build more power-efficient sensors and have been able to bring access to those remote areas. Similarly, from a policy perspective, back in 2020, the FCC assessed there were 600,000 tribal households that didn't have broadband. And through some spectrum policy innovations, there's now programs rolling out internet access to 15,000 tribal households in Oklahoma, North and South Dakota. So those kinds of tech innovations will move to be far broader in 6G. Now, to your point, where are the risks? So on the national security side, you talked about US or China's leadership in this space. We certainly see much tighter linkage now between the Chinese government, not only state-owned firms, but their private sector telecom firms like Huawei and ZTE. And in fact, we believe over 90% of private sector Chinese firms now have Communist Party cadres in those firms who can influence the decision making. When you think about telecom, there's millions of lines of code in the software, in the hardware. And when there's that much code, if you can't trust your supplier, you can't have confidence that data won't be spied on, that communications won't be disrupted or degraded in a time of crisis. So ensuring that we get the security right in 6G is absolutely essential.
And Anne, how difficult will it be, though, for Washington to really sort of dictate some of these standards when you do have different countries developing their own standards when it comes to 6G?
Great question. So, we invited a number of like-minded allies and partners to come to the event, and we're planning a ministerial in the next couple of months, really bringing together other key countries who share our goals from an economic perspective, from a national security perspective. A number of the key telecom players today are European companies, and our goal is to work together to discuss how do we ensure the standards enable open, resilient, secure, and diverse telecommunications, both the technologies around 6G.
And then when it comes to China and say Russia and sort of expanded cybersecurity there, then what does that mean for sort of trying to compete with those standards as well as sort of tracking the developments in cybersecurity that really some of these companies in the US also need? We know that last month the Biden administration rolled out some of these minimum mandates when it comes to cybersecurity, whereas before, companies could do this on a more voluntary basis.
As you talked about, technology is spread across our entire economies. It's a part of our lives. So from a Biden administration perspective, the president has really made it a priority to improve the resilience of critical infrastructure so Americans can have confidence in their water systems, their power systems. And I think what we've acknowledged is that after the last 10 years of public-private partnership, which has made progress, our adversaries are making far more progress in compromising technology than we've made in voluntary efforts in building more secure tech. So the goal of the Biden administration's work over the last 2 years has been to put in place these minimum cybersecurity practices. They're the kind of best practices we've been talking about for many years. Multi-factor authentication, patching systems rapidly, and to say if you're an operator of critical infrastructure in the US, if you're operating a water system, if you're operating an oil and gas pipeline, we need you to put in place those minimum cybersecurity practices because we saw in the May 2021 incident with Colonial Pipeline the impact that a cyber attack, and in that case it was a criminal, wasn't even a nation state actor, but the impact that vulnerabilities in core critical infrastructure can have on Americans' lives. And that's the reason the Biden administration has made that switch to say, we need to ensure that those critical infrastructure services are as resilient as they need to be to meet the threat.
We do appreciate you joining us with your insights this morning. Ann Neuberger, Deputy National Security Advisor for Cyber Emerging Technology. Thank you so much. All right, coming up, are investors and corporations merely giving lip service to ESG commitments? If so, how do we really make it a priority? Schneider Electric has something to say about clean tech. More on that next.
Earnings, earnings, and more earnings. It's a big week ahead for investors. All eyes focused on the tech titans lining up with their latest earnings report. Here's what you need to know. First up, it's a doubleheader Tuesday with Alphabet and Microsoft set to drop Q1 financial results after the close. Alphabet investors will be watching for details on the company's AI investments, while Microsoft shareholders want to know if Microsoft Teams has acted as a tailwind for the company's growth. Next up, Meta. The company formerly known as Facebook will report first quarter earnings on Wednesday. While Meta has been making headlines with the latest round of layoffs, investors are likely to keep an eye on the company's monthly active users and its new strategy, the growth of the metaverse. And rounding out next week, Amazon will report on Thursday after the close. The company recently joined in on the AI race, but will their bet on artificial intelligence pay off? Investors will be listening for AI mentions on the call. We will have all that covered on Yahoo Finance, and tune into After the Call Tuesday, Wednesday, and Thursday with a breakdown of the big tech earnings calls.
Tech innovations are key in the push towards a cleaner future. The road to a clean energy-based economy is propelled by new forms of energy. Here to discuss the energy transition is Amir Paul, Schneider Electric North America President. We also have Yahoo Finance's Julie Hyman here joining in the conversation. A big welcome to you both. So first, Amir, when people are looking at this as not just a nice to have, you talk about companies that choose to integrate digital and sustainable transformation in their value chains. 2.5 times more likely to be among the best performing businesses than those who don't. Why is it still then seems to be such a hard sell?
First of all, I think it's actually becoming something people are more convinced they have to do. And the conversation has gone from should we to how do we? So I'm actually quite optimistic that it is becoming something more people are investing in. If you look at the last couple of years, we have to have empathy that a lot of people were dealing with seismic issues in supply chain and production, in demand variability. And so it's coming out of that and putting a parenthesis at the end of the COVID effort and starting this new effort, knowing that we have to begin now to have effect over the next decade. If you look at Europe, they've had to be forced, unfortunately, due to the war in Ukraine, to do in 18 months what we have a longer time frame to do. So it's about taking advantage of that opportunity. But I'm actually seeing a lot more companies lean in and pivot from should we to how do we.
I'm curious, Amr, what are some concrete examples of what exactly we're talking about here? So what does digital tech and climate, are we talking smart thermostats, light sensors, things like that? And I imagine it also gets more sophisticated than that.
Yeah.
So what does it look like?
Look, that's a great example. I'll give you two use cases, one in your home and one for industry. So in your home, imagine that you go from being just a user of energy to a prosumer, a producer and consumer of energy. What does that look like? Well, it starts with you get solar panels. Now you're producing energy. Now if you get battery, you start storing it. Now if you get an EV with a bidirectional charger, your car is also a consumer of the energy you created through your solar panels, but also a source of storing that energy. Now, inside the home, when you choose as a consumer, you can take loads like your gas cooker and make that electric. So as you electrify the home, owners have this real control about becoming producers and users of energy, and using technologies like VPP programs and the right policy, they can sell that energy back. So at CES Consumer Electronics Show earlier, we demonstrated an app where you can put your home into make me energy mode, save me energy mode, and prepare for a storm mode. And that's an example of what we find in terms of smart energy and sustainable solutions. Now, you go to a factory environment. We have a factory in Lexington. It's 64 years old. It makes panel boards which go into homes. And we asked the team to use digital technology to see where they could find waste. So the first step is to use digital to survey where you're spending your energy. Then it's to decarbonize using things like microgrids, solar solutions, PPAs. And finally, it's to make sure that you are automating your processes. So the combination of those things over 3 years has made that a World Economic Forum lighthouse factory. It saved 25% of its energy usage, 30% of its water usage, and is on its way to being one of our most productive facilities. So not only is it more energy efficient, but the raw efficiency means that we can actually do more even with a higher labor cost structure. So those are two examples of the journeys we give people.
And just a quick follow on the consumer side. So you mentioned the app. Where else does Schneider sit in that process? Where do you participate? And what has been the uptake for something like that app?
So lots of different places, right? So if you look at the core infrastructure with our Square D product set, we've been part of the electrification of homes in America for a very long time. In fact, 4 out of 10 homes in this country have our content in them. So we work with the large builders like D.R. Horton and KB Homes to build those solutions out. Today, if you went about an EV, you would generally get a service solution from a company called Qmerit. Qmerit is a Schneider partner and company we've invested in, and they will send an electrician out. So they'll match the demand of the user, sort of like an Uber experience with a certified electrician that'll come out and help you deploy the solutions for your new EV, but also talk to you about battery storage and solar. And then lastly, we do that at a community level. One of the more exciting projects we had was with KB Homes, and it's a Department of Energy funded demonstration project where the entire community of 200 homes is grid independent. So even if the grid has an outage, that community with a microgrid can continue to operate. And we see that distributed energy will be a big part of that. So we operate at the atomic level, we operate at the solution level with OEMs, and we operate at the community level.
And Amir, I want to hone in on the EV space here, because a lot of people, when they think of investing, they're thinking, perhaps just the cars, the vehicles themselves, or perhaps the solar technology. But you're talking about digitizing really throughout the ecosystem of an EV. Break that down for us.
Well, if you think about it, the EV, and GM and others have talked about this. GM recently talked about becoming an energy company. Tesla's talked about that. Why is that? Because the battery in your EV offers an incredible store of energy. Now, there are some practical use cases. If you want to be in a weather event, do you want to just discharge your one mechanism of going to a safer place, right? So how will people use that is a different conversation, but can we make sure the physics allow for the store of electricity in your car to also be available to your home? That's entirely possible. And bidirectional charging is what makes that happen. And so more and more people can start thinking about their entire energy resilience, and the EV as a part of that equation. And some of these cars are being marketed with that, which makes sense.
I want to circle back around to something Rochelle asked about. And you said, Europe has sort of been forced to move more quickly because of what's been happening with the energy landscape there. I mean, you've definitely seen emergencies here, I think of Texas in particular.
Absolutely.
And grid
California.
resiliency exactly being an issue. And I know you have obviously a business case to make for this, but just also from a grid resiliency case, do regulators need to be more forceful on this front? I know there's been stimulus in this direction, but does there need to be more to push the U.S. in that direction? I think
a lot is being done, and I think we're encouraged by it. I think what would be interesting is to make it easier for distributed energy resources to come into play. So, we're actually speaking to the DOE about these things, and one of the things we talk about is how to make sure that interconnects are easier to put in. Permits move faster. Sometimes permitting is taking 5 years. And if you think about the Europe example, right, a permitting process that takes 5 years would not survive a crisis like they've had to go through. So how do we get that urgency in changing our system? And then there's obviously some concerns from the existing utilities about their economic structures and their models, especially in regulated environments. So I think those are the areas. The interesting thing is the technology already exists. That is not our barrier. The economics of the technology are getting better every day, and the cost curves are coming down. It is now a policy condition to allow for a new business model to come into play, and I think that's where we are. And if we can move faster there, that would certainly be encouraging.
I do want to thank you for joining us this morning. Amir Paul, Schneider Electric North America President, and our very own Julie Hyman. A big thank you. All right, coming up, the end of Bed Bath & Beyond. What the company's failure means for the retail space. We've got that next.
Siri, what is metadata?
So you want to know about metadata? Of course you do. It's come up in a lot of conversations, especially around some of the social media hearings that have taken place on Capitol Hill. So what is metadata? Metadata is essentially the data about data. And to break that down even further, say you post a picture. That picture even when you've taken it, already has the location that that picture was taken at, the date that it was taken, the type of camera that you were probably using. Those three things and more amass the metadata. But here's where it comes into play for some of the social media companies, is because when you post that image, you are essentially giving that metadata over to the social media companies, and you're allowing them to then catalog some of that metadata and create an advertising profile on you that they can then index and be able to resell to other advertisers. So for social media companies, that metadata is incredibly important. There's some data that you volunteer when you sign up for a profile, but there's other data that you're giving them not even knowing it. And that is how you get advertised to on such a granular level, and why some of those ads are so relevant. I missed the cup.
Let's take a look at some trending tickers now. Here are the biggest movers ahead of your lunch break. Bed Bath & Beyond's bankruptcy fallout continues. Shares are down currently more than 33% after the retailer filed for Chapter 11 bankruptcy over the weekend. It plans to close all remaining stores within the next 2 months, marking the end of a very tumultuous past few years. Also on deck, Coca-Cola. It's trending upwards on positive earnings news this morning, up about 1/3%. Now, even though the company hiked prices in the first quarter by 11%, customers appeared unfazed. Strong demand pushing Coke to beat revenue estimates. And of course, you can't beat that brand loyalty. And in banking, First Republic is expected to report earnings later today. The regional bank was caught up in the chaos of the banking crisis after SVB's collapse spooked investors and sent shares plummeting. Today's earnings will show just how much damage First Republic sustained and what the road ahead looks like. And finally, Fox Corp shares taking a hit on news anchor Tucker Carlson leaving its news network. Carlson, arguably the most high-profile face in Fox News' history, parts ways just days after it reached a historic $787 million defamation settlement with Dominion Voting Systems. As you can see there, the stock down about 3.8%. All right, well, let's get you a final check of the markets as we head into the noon hour. It was a mixed picture earlier, but now we see all three major indices in negative territory, some of that selling action picking up. The Dow there down about 50 points, just fractionally there. The S&P 500 there also down about 13 points, about 1/3%. Also taking a look at the Nasdaq, that's down about 1% on the day, seeing that selling action pick up. More heavyweight earnings, of course, still rolling in, and we're expecting big tech to really take center stage. We mentioned First Republic and Coca-Cola trending. Also seeing some in the AI space, with C3 AI also trending down, was down about 12%. Getty Images also up about 40% on the day, enjoying some gains. So just some of the trending tickers that we're watching for you. We'll be sure to join us back live again at 3 p.m. Eastern. And you can always catch me tomorrow at 11 a.m. Eastern on Yahoo Finance. That does it for now. I'm Rochelle Akufo. I'll see you then.